Morning,
Morning,
sir.
sir.
Make some
Morning,
noise.
sir.
Make
Good
some,
morning, sir.
make some noise.
Good
Yeah.
morning, sir.
Good morning. Good morning. Good morning.
Good morning, sir.
Good morning. Yeah.
Good morning, sir.
Okay. So let us start the beautiful session called Financial Reporting, a complete review, including RTP. So for the 3 hours, maybe in between 5 to 10 minutes, I'll give a break so that the knowledge doesn't pour, rather it doesn't become over the heads like in costing we have, no? Right. And today is the one unique day, 10/10/2020. What is the date today, Neha?
10/10/2020.
10/10/2020.
So it is an indication that whatever you learn here, so please put your double effort so that you should be able to get not less than 100 in FR. That is the objective of this batch. From the beginning, when I started the class also, so knowledge-oriented education only, we concentrated CAPS, concept period. But at the end of the day, it has to be connected to the marks, because just knowledge without marks is of no use at CA level. And now you have to connect it to the marks. All these days, yes, knowledge, concepts, everything we have done. Let us see today how easy FR paper. Even in the evening, we have an examination session where I'm going to make it further easy. Okay, so where each subject, not just FR, accounts, income tax, all those things we are going to discuss. So without wasting much time, let us directly venture into this. So financial reporting, their thorough analysis, I'll be doing it, and trust me, where it is like a what you called entire movie in just 3 hours. Okay, entire movie. It is not trailer. That's the way I'm going to cover it. Okay, because I'm doing it for several years, but thankfully, because of the online, we have got more facility now to do the things in a much better way. Fine. And this material also will be shared with everyone. Okay. So I think subject, let us concentrate on the board. Board is visible? Yeah, I'll
Yes,
Yes,
sir.
sir.
increase the size. बड़ा है तो बेहतर है. It is enough, or you want still bigger?
So this is fine, sir.
Perfect. Okay, so that's very well. Okay. So my accounts class, whether the foundation, inter, or final, is incomplete without the definition of accounting. So beautiful definition given by AICPA uses the term RCS, recording, classifying, and summarizing. Probably at foundation and intermediate level, we'll be concentrating on then recording, journal, classifying, ledger, summarizing, balance sheet and P&L account in a significant manner and in terms of money transactions. So I purchased a pen, record. I purchased a cow, record. I exchanged cow for bull, also record, because they are monetary transaction. India 16 takes care of it, ES 10 takes care of it. And events there which are in part at least of financial character. So money or money's worth, and interpreting the results thereof. The last portion of the definition is the CA final portion. That is preparation of balance sheet. How do you present? How do you report? All these are important. Fine. Now at CA final level, we are focusing mainly on financial statements of a company. So 2 within bracket 40. Remember the section of the Companies Act. If I don't mention, it is always Companies Act of 2013 in account subject. Whereas if I specifically mention, probably I may go to Income Tax Act somewhere here and there. Otherwise, it is only Companies Act of 2013. This is the disclaimer I'm having right now. So financial statement, normally at a CPU level, we used to ask, when I used to ask, what are the financial statements? People say P&L balance sheet. I'm sorry, ultimate financial statement is balance sheet. So balance sheet, and unfortunately under 240 they use the word P&L account itself, even though under section 129 subsection 1 they use the word statement of P&L read with schedule number 3. Here they use the word P&L account. So 240 पूछा तो P&L account mention करना है, and if it is NPO, it is income and expenditure account. And very important, cash flow statement, then Ind AS companies, because mainly new syllabus Ind AS is there. So see, statement of changes in equity and explanatory notes, extremely important. My dear friend, at CA final level, it is not about the mathematics of tallying the balance sheet. It is all about, okay, how you present your financial statements. That is all about how you present your financial statements. Right. Now, so there is a clarification. OPC, small company, etc. They need not have to prepare CFS. They need not have to prepare CFS. Now, the interconnection with the statutory reference, Companies Act, section 129 of the Companies Act deals with the financial statement. Every company every company at AGM, have to lay down the financial statements so that true and fair view, okay, of the financial statement, the balance sheet and P&L is what you call understood. Extremely crucial term as far as accounts is concerned. True and fair. Whereas when it comes to income tax on it, form number 3CA read with 3CD or 3CB with 3CD, there the word is true and correct. Whatever is information given is true and correct. So there beyond that I don't go. Whereas true and fair, you have got more responsibility, wider responsibility. That's the word used, true and fair. So whenever you're writing auditing, if there is a reference about true and fair, 129.1 is the reference section. Schedule 3 talks about a format. It is applicable to all the companies, including electricity companies. Now, electricity companies are also following Companies Act of 2013. Section 133, most crucial. Every company must follow the accounting standards which are notified, which are relevant for that. For example, if there is no holding subsidiary relationship, where the question of Ind AS 110, where the question of AS 21. If it is relevant, you must follow. Banking, insurance, because they're special statutory company, they have separate format. Banking Regulation Act of 1949, insurance IRDA, Insurance Regulatory and Development Authority Act, okay, for 1999, they give a separate format for that. So which may not be relevant at this stage, but go through somewhere in auditing, it might be relevant. Now, financial statements. Companies, normal companies and electricity companies, as I said, Schedule 3 of the Companies Act. Banking company and insurance company, separate format. Non-corporate, there is no format. Whatever you want to follow, you can follow here, okay? But whatever you're following, at least you should follow in a reasonable manner. Simply, you cannot write first land, then cash, then building, then debtors. You cannot write some format. Like, see, Dhanush, when he was following a girl, okay, so a girl came late to the class. So I asked, why are you late to the class? Sir, Dhanush was following me. Then why are you late? She says, Dhanush was following me slowly. At least there should be some consistency as far as your following is concerned. So even in account format, okay, you need to ensure that the format, etc., you follow consistently. So permanency order or liquidity order you can follow. Right. So Aditi, allow the people depending upon the name, etc. Right. Now going ahead. Yeah. Next. Consolidation format is also absolutely same, whether it is standalone financial statement or consolidation with non-controlling interest and minority interest. That is the extra point which need to be taken care of. Fine. Next. Now, very crucial at CFN level. Schedule 3 of the Companies Act deals with the financial statements. Schedule 3 has 3 divisions. Division 1 meant for non-Ind AS companies, chota-mota companies, small companies. Division 2, bada hai to behtar hai, I said no, it is applicable to Ind AS companies. We'll discuss which are those Ind AS company applicability. And Division 3, which has been notified for NBFC from 31st March 2019 financial year. So we have 3 divisions. And all the 3 divisions have part 1 and part 2. I have not given connected to division 3 here because it may not be there in your syllabus. Have an idea that there are 3 divisions. Division 1, Division 2, Division 3. Speed is okay. Pace is okay. Neha, Surabhi?
Yes, sir.
Yes, sir.
Right. Thank you. Now, applicability of Ind AS is basically from financial, there is a detailed discussion later. From financial 1718 onwards, I'm not talking about when it's made mandatory. From 1718 onwards, it is applicable to every listed company and small b, that is small b, unlisted companies where the net worth is more than or equal to 250 crores. We'll discuss that little later. So special companies, which are the special companies? So banking, insurance, electricity, it's covered under normal company asset. For NBFC, as far as Ind AS is concerned, phase 1 is from 1/4/2018. For everybody else, 1/4/2016. Wait for some time. So NBFC is from 2018-19 it is applicable when the net worth is greater than or equal to 500 crore. For all other NBFCs which are having more than 250 crores, it's from the next year, 2019, as far as phase 2 is concerned. Banking companies and insurance companies, Ind AS has been deferred, so till it is notified. Fine. So just for understanding, Division 1, new scheme only Division 1 may not be relevant, but have an idea. Whereas old scheme Division 1 is applicable. Take care of it. Division 1, the balance sheet format is based on the companies within the bracket accounting standard rules of 2006. Now, on the liability side, listening? Yeah. On the liability side, so it starts with the wife on the top, husband down. Okay, equity and liability. Earlier I used to say husband right side, left side, wife. Now Why equity and liabilities on the top? Okay, so who is responsible? Who is asset liability? Don't bother. On the top, it is actually equity and liability, and niche kya hai? Assets. So Sri Rama and Sita necessary for capital. This is one format which has become very famous. Okay, so on the liability side, shareholders' funds, reserves and surplus, non-current liability, current liability. Under that again, each item. What is this? SRM. So Rama used monkeys. There is nothing but share capital, reserves and surplus, money received against share warrant. So on the top, I'm sorry, shareholders funds, share application money pending allotment, non-current and current. So under shareholders funds, we have share capital, reserves surplus, money received against share warrant, and a separate line item under the division one is called minority interest. Then again, under the non-current liability and current liability, we have almost same items, except that deferred tax liability is always going to be non-current, whereas trade payable is always going to be current. So these are short form what we are given. Same way on the asset side, we have new non-current assets and current assets. So now fixed asset has been renamed as a PP. Right or wrong, I don't know, but it should be renamed as what? PP. Technically, in my opinion, fixed asset should be a generic word for tangible and intangible. They call PP. Why PP? Only PP. You can simply call tangible, but that's the name given. We can't help it. We have to go by that. So same way, current assets, citizen insisted test, that is current investments. Then ITC, three crucial word. ITC, inventory, trade receivable, cash and cash equivalent. Then short-term loans and advance, other current liability. I'm just touching it and leaving. I'm not going for the detailed discussion because it may not be part of your new scheme syllabus. Next, I'm sorry. Division 2, as it is copied from the study material of ICI, okay, because we don't want to do the, what do you call, changes. So the company's accounting standard rules of 2015, company accounting rules of 2015. So start with the, so ultaiga now. Okay, on the top it is asset and down kya liabilities. So the top it is what? Non-current asset. Non-current asset, and down it is a current asset. So on the top it is assets, then equity and liability. Under assets, non-current asset and current asset. It is very crucial now because all these are going to be connect to the accounting standards, Ind AS. Very, very important. Now, first 6 items, please look at this. You're able to see the color, what I'm doing it. PDF, obviously, we cannot do multiple colors as of now. So, we'll be able to see.
Yes, sir.
Yes, sir.
Selection agide, sir.
That's a selection, because we cannot do the coloring. We discussed this.
Yes, sir.
PDF, we cannot do the color. We have to do some research for that also. Fine. So first, so how to remember this easily? There are 10 items. Okay. So there are 10 items basically under the non-current asset. So yes, 10 is 10 item, but more of a fixed asset. And these 10 items, first 6 items are related to fixed assets. Out of that, first 3 are related to tangible, next 3 are related to intangible. So property, plant and equipment. If building is under construction, that is called capital work in progress, then investment property. Fine. Next, goodwill, other tangible asset and intangible asset under development. So first 3 tangible, next 3 are intangible. Then we have biological assets, which are excluded from the PP standard, and other than bearer plants. We have some discussion later. Then financial assets, extremely important. Ind AS 109. ITL, you must remember this ITL short form. Wherever possible, keep a note of it. Keep on writing in your notes book. You can keep on book and keep on noting it. Because 3 hours, you should at least get, when I complete, you should get, hopefully you have attended the regular class. Wherever you attended, you should now at least ensure that 40-50 idhar hi aana chahiye. Then again, sit and prepare 100. Minimum 100 aana chahiye. Minimum 100. If C Institute, because the COVID-19 offer, if they give 110, I'm happy. Then SFM, if you get 90, 200 out of 200. Excellent. So then we have a special item called deferred tax asset, Ind AS 12, and other non-current assets. So first 6 are fixed assets. So first 3 are called related to tangible, next 3 are related to intangible. So PP under development is called capital work in progress, or capital expenditure work in progress. Then investment property, special one. Then goodwill, other intangible asset under development. It's something similar to the first 2 only. So PP under development. Intangible asset under development, but a special item is goodwill. Goodwill is always a special item. Okay, keep it. Next, financial assets can be ITL, investments, trade receivable, loans. Deferred tax asset is always non-current. I'm not fully agreeing with the classification, but format has given that. So a simple example, if because of 43B, etc., if there's a reversal of an asset or liability within 6 months or 1 year, why it should be non-current, I don't know, but it is always non-current as per the format. Fine. Then, so this is about the non-current assets. Then we have current assets. Current assets are concerned. It is a IFCO Tokyo ಅಂತ ಒಂದು ಇನ್ಶೂರೆನ್ಸ್ ಕಂಪನಿ ಇದೆ, ಬಟ್ ಸ್ಪೆಲ್ಲಿಂಗ್ ನೋಡ್ಕೊಳ್ಳಿ, IFCO. Lot of short form acronyms we are going to use. IFCO. Inventory is always current. Then financial assets, very, very important. Financial asset can be non ಅಥವಾ current asset. Then C for current tax asset. Be careful, it is not deferred tax asset. Current tax, advance tax हमने दिया. Net advance tax given is 10 lakh. Whereas provision for tax is 8 lakh, then 2 lakh rupees it should show here. It is always net. Very important focus, because every examination there's a question on the financial statements. Recent RTP also there's a question on the financial statement. They will do some mistakes intentionally. They will tell you to correct and represent it. So old scheme and new scheme, both the cases is extremely important. Take care of it. So advance tax 10 lakh, oh, alag se likh denge. Provision for tax liability भी लिख देंगे नहीं. They have given very categorically net. So 10 lakh minus 8 lakh, 2 lakh. Whereas if advance tax is 10 lakh, provision for tax is 15 lakh. All of you are able to understand? Reaction?
Yes, sir.
Yes, sir.
It is not fast, no?
No, sir.
No, sir.
But it is a revision class. It cannot be too slow also, because without revision there cannot be revision, isn't it? Yeah, fine. So when you talk about the current tax asset, advance tax and provision for taxes, let it off. If advance tax is 10 lakh, provision for tax is 15 lakh, then it should come as a current liability. It should not come here. It should come down. So asset side is concerned, I hope, please be master. I know all of us have started from PUC balance sheet, but the format is extremely crucial. In and out, you should know, in and out. So non-current asset, first 6 are related to fixed asset, which I generally call it as. Out of that, first 3 are related to tangible, next 3 are related to intangible, next 4 items special item. So biological assets, which is also a reference made under Ind AS 16, which is be excluded from fixed asset. Then next 3 items are FDO. What is FDO? Financial assets, deferred tax asset, other non-current. Whereas when it comes to current assets, we have IFCO, inventories, financial assets, then current tax asset and other current assets. Other current assets. Next, coming to the liability side. Okay, first equity, very, very important. Yes is concerned, normal yes, ICS standard or compare law standard, we just write equity, reserves, surplus together. Here, equity share capital has to be shown separately, equity share capital alone. Please understand, equity includes even preference share capital. Equity means owner's funds. But equity share capital, ordinary share capital has to be shown separately. Other equity, you have to make a statement, either columnar way, one by one. Anything is fine, absolutely no issue. So when it comes to the equity share capital and other equity has to be shown separately. SOC, other equity is nothing but SOC, statement of changes in equity. Fine. Next, when it comes to liabilities, again, liabilities we have non-current and current. Everything is based on current and non-current. So non-current liabilities are other than current. Current means they are given a definition there. We'll see later. So it is a FPDO. There, so non-current assets, there are 10 items. Here there are only 4 items. Which are the F means financial liabilities, then P provision, deferred tax liabilities always non-current, other non-current liability, FDPO. F means what? Financial liability. You have to remember BTO. There, if you go back and see, when it comes to non-current asset, I said financial asset, ITL. Remember that. When it comes to current asset, ITL is there. ITL is, which can be non-current. Investment can be for long-term or short-term. Long-term or short-term. Long-term means it comes under non-current. Short-term means it comes under current. ITL, same ITL. In addition to that, CBO. I used to say ITL plus CBO. What CBO? Cash and cash equivalent is always current. Then bank balances, then other items. So, under non-current, financial assets are ITL. Under current asset, it is ITL. You can. So, I made investment for 6 months, current. I made for 16 years. It is a long-term, non-current. So in addition to that, cash and cash equivalent cannot be non-current here. It has to be current unless fixed deposit you are kept, which is for a long term, some restriction, etc. So it is always going to be coming under the current asset category. That too from the cash flow point of view. So same way, when it comes to the non-current liabilities, Non-current liabilities, FDPO. Same item, slight change. Current liability, FOPC. So, ikkada chudo. So, there it is FDPO, here it is FOPC. What is FDPO? Financial liabilities, then provisions, deferred tax liability, and other non-current liabilities. Under financial liabilities, BTO. What is BTO? Because you're looking at a liability. Borrowings, trade payable. Trade payable can be current or non-current. Inventory cannot be non-current. Trade receivable and trade payable both can be current and non-current. So other financial liabilities. Then deferred tax liability I said. Then current liabilities are concerned. So FOPC. What is FOPC? So same. Whatever we have mentioned here. All of you listening? Yeah.
Yes, sir.
Yeah, fine. So financial liabilities. So it should come down a little bit. Financial liability. Then O means other financial liability. Then provisions, current liability. So FOPC. So FOPC is financial liability. First item. That should have been the first item below that. So then other financial liabilities, then provisions and current tax liabilities. So this is the sum and substance of the entire balance sheet. I just repeat. So division 2 starts with the assets. Under the assets, first one we have is what? Non-current asset. Non-current asset has got 10 items. First 6 are PP related, fixed asset related, sorry. First 3 out of that is tangible. Next 3 are intangible. Then biological asset is a special item. Then FDO. Then under financial assets, it can be ITL. Same items are appearing under current also. So ITL plus CBO, 3 more items. Then current assets are concerned, inventory, financial assets, current tax asset, and other current liabilities. Fine. Next, equity and liabilities. Equity share capital has to be shown separately. Other equity, a separate table has to be made. That's a columnar presentation. Then liabilities, it can be non-current and current. Under non-current, okay, FPDO, financial liability. Under current also, we have financial liability. Same thing. Then what are the items here under financial liability? BTO. Here also same BTO. Current liabilities and non-current liabilities both are same. Are you getting confused?
No, sir.
Okay, right. Great. So
No,
next,
sir.
yeah, FPDO is financial liabilities, provisions, deferred tax liabilities, and other non-current liabilities. So here under current liabilities, it is FOPC, financial liabilities. It should have been the first item, printing error. Then other financial liability, provisions, and current tax liability. They are deferred tax. Here current tax. Everything else is same. Everything else is same. I hope you understood. Now again, you have to connect it to the Ind AS. Ind AS or account standard, whichever is applicable to you. So PPE, capital work in progress, comes under which standard? Tell me. Ind AS number.
16.
Ind AS 16. So what you can do, you can make in a regular class. We have made that beautiful analysis. Side by side, the format, all standard number also we have written. Nenipidya?
Yes, sir.
Yes, sir.
Same way you can
Sir.
copy here also. Then PPE, capital work in progress, investment, PPE, capital work in progress comes under 16. Investment property.
40.
40.
Goodwill.
38.
30.
8.
8.
30 sale 38. Other intangible assets, 38.
38.
Then next also 38.
38.
Biological assets, reference made under 16. 16 also, 41 also is there. So 16 and 41, reference made just to exclude. Financial assets.
109.
109.
Deferred tax asset.
12.
12.
Well, excellent. Other non-current asset, no standard. Same way, inventory.
2.
2.
Inventory is concerned, wherever you go, it is 2 only. Okay, opening stock and closing stock. That's why it is always 2. AS2, Ind AS 2, ICDS Roman number 2, all same. Financial assets.
109.
109, 109, 109, 109, yen ಬೇಕಾದ್ರೂ ಬರ್ಕೊಳ್ಳಿ. Yeah. Current tax asset.
12.
Well, reference made to it is deferred tax mainly, but that's also coming under Ind AS 12. Next, mainly on assets, we have a lot of standards. Then coming to financial liabilities again, 109. Then provisions.
37.
37.
Deferred tax liabilities.
12.
12. Other non-current liabilities, there is no such special point. Okay. Same way, other points also you take care. So division 2 and Ind AS, very, very important. So in you will be circulating this material. Okay. No extraordinary item. No extraordinary item. So under Ind AS, there is no concept of extraordinary item. So in AS, we have a concept called extraordinary. No extraordinary item. So remember for life, nowhere, even when I go to Ind AS 8, we will mention that there is no concept of extraordinary item. And show OCI separately. Okay, now listen. As far as the P&L is concerned, so you have single statement approach or double statement approach. Single statement approach means normal P&L you prepare, and then you show OCI, other comprehensive income. So double statement means split and show these two separately. So there are two special points. So CFL points, you can keep on noting it. I will not tell you to write down separately. P&L, the word used is OCI, other comprehensive income. In the balance sheet, the word used is OCE, other components of equity. OCI. Okita, is it going inside? That is the P&L. From there, you come out. There is external. There is the balance sheet. OCE. OCI is in P&L. Other components, other comprehensive income. And OCE is what?
Other components
of equity.
So please remember that point, first point. Then in division 2, I'm specifically focusing on division 2. So we need to show EPS separately. EPS for basic and diluted, including negative. See, look at the beauty. 3 points we are covered in one line here. That's the beauty of revision. Basic EPS bhi dikhana hai, diluted bhi show karna hai. Whether the positive or negative, baad mein gaya. Because today positive is negative, negative is positive. Correct, no? So coronavirus.
Yes, sir.
Yes, sir.
So positive or negative. Remember, these are all stupid words I sometimes use, but that's the way you remember the subject. So positive or negative, dikhana hai, that's it. From how much is from continuing operation? And Ind AS, the word is discontinued. Ind AS 105. Discontinuing Allah, discontinued, unlike AS 24. Discontinued operation. And then they say from continuing and discontinued. Even though general purpose we use the word total, if you want to be very specific, the word is EPS, continuing, discontinued. From continuing and discontinued, you should not use the word total. Fine. Next, in CFS, minority interest is written if you are an old scheme friend, division 1 only. Under the equity, separate line item. Separate line item we should show. And non-controlling interest is the word used for division 2. So division 1 for old scheme friends, division 2 for new scheme. But both the category people should have an idea about both. Because old scheme, there's a comparison being asked, AS versus India. New scheme, somewhere they might touch, somewhere they might. India's, when you talk about 135.1, corporate social responsibility. Somewhere if they ask you for a small private limited company, you need to know. General knowledge, don't go too much into that. Next, Schedule 3, special point, previous figure must be given. Again, very important. Small matters, I keep telling this, okay? You can go and sit on the top of the mountain, but you may not be able to sit on the pins. Very dangerous. Same way, small matters don't ignore, because accumulation of all these things will become a huge. So when you're preparing a balance sheet, previous year column is a must. One of the expected question in that rectification of financial statement, they normally give a financial statement with one column. So next moment you see 1 mark, you'll get what? So previous column is not given unless it is a first year of operation. Be careful. If it is a first year of operation, what? Booth Bangla you have to show. Previous year from where? I don't know. So then you have to make a sentence. It being a first year of operation, previous year figures are not given. So these are the special points to be taken care. Fine, coming down. Now, accounting standards. We have got plethora of standards, but I have simplified and said almost everything is same here. Everything is same. Only the what you call different bottle. We have put the shape of the bottle is different. Wine is same. Don't get into that anyhow. Accounting standard at a corporate level, if you're a big company, bada hai to behtar hai, neha, that is called Ind AS. General word. It is not what is a large company. For all others, company law standards. Sir, I am a proprietorship concern whether account standards are applicable to me. Account standards are not applicable to me, but the auditor should ensure, August 1994 C Institute Journal, auditor should ensure that account standards are followed. If account standards are not followed, he has to express an opinion. ICAI cannot mandate a proprietorship business fellow to follow ICAI standard. But the chartered accountant who is giving the opinion, if it is a tax audit case, he must give or ensure that it has been followed. If not followed, give an opinion. So I have a Panbida shop. Surabhi is my chartered accountant. She comes and says, account standard follow model. You cannot, what you called, you should follow account standard. I say I don't care, because ICAI is not a law of the country, just like Income Tax Act. Income Tax Act is applicable to all of us. ICAI governs ICAI members. So Surabhi as an auditor, she has an obligation to ensure that I followed. If I not followed, report. She has to give a report. That's it. Fine. So for non-corporate, ICAI standards AS1 to AS29 minus AS6 and AS8. And income tax, ICDS Roman number 1 to Roman number 10. Fine. Now ICDS numbers are similar. Okay, so similar. 1 is equal to ICA 1. ICDS Roman number 2 is 2. Then we have some connections which at the end I'll discuss. Now, just to tell you, compare law standards here, what I presented, and ICA standards are absolutely same. That means these two are same. Then ICDS and ICA are almost same, 98% same. That means this one, and this are same. What about Ind AS? Ind AS is almost like a 95% of IFRS plus or minus carve-in and carve-out. Here also, it is not substantial deviation. Some of the standard like Ind AS 37, which is almost like AS 29, because AS 29 is the last standard under the ICA existing standard. So that's why it's almost similar. So you don't have to think, oh, tumba difference is there too much. I was telling, like initially when the Ind AS was introduced, but many people were getting confused. Ind AS karna, AS karna, because C Institute also had not given a clarification. So what I told, extreme case, if you don't know Ind AS, solve as per AS and write as per Ind AS, you'll still get the marks. Okay, some places, not that every time you'll get this answer. Next. Now, for the purpose of Ind AS, we have companies, Ind AS companies and other companies. What about ICA standards? So they have level 1, level 2, level 3 enterprises. So there's a classification. So more than 50 crore turnover, more than 10 crore borrowing, etc. comes under level 1. More than level 2 enterprise is small, which is a little smaller than level 1, and level 3 is other than this. So this is called non-SME. These two put together are called SME, small and medium enterprise. If it is a company, use the word small and medium company, where here use the word small and medium enterprise. Right. So the next most important aspect, this discussion may be relevant even for our auditing. Somewhere in auditing also it might be relevant. From when and how Ind AS is applicable. So before I continue, like Akshay, once you are married, you are always married. That's it. Correct,
Yes.
Akshay?
Yes, sir.
Yeah, right. So same way, once I say Ind AS is applicable for this year, that's it. Next year onwards, again, you don't have to check this net worth, etc. Check karega. You are in, that's it. Akshay is married now. Married means married, full stop. You can only have a, what do you call, wow, feeling of happiness. Correct, no, Akshay? Now you are married. That's it. Either happy or married.
No unwinding.
What, Jairam?
No unwinding.
No unwinding, correct. No unwinding, maybe Asha madam's language. Okay, no unwinding. So you are either happy or married, as the case. Be happy, no problem. So no doubt at caps, happy and married also comes into picture. Enjoy.
Happily married.
Happily married. That's it. Oxymoron sentence. I like it. Okay. Yeah. Happily married. Yeah. Fine. Now, applicability of Ind AS. So first point you should notice, the base date for net worth computation is 31st March 2014. Now, 14. Let us have the love towards this subject. 14th February, we remember Raksha Bandhan. Ye Bandhan to hai na, isliye. So, 31st March, but don't go by 14th February. It is always year end. So, remember the base date, 31st March 2014. First point. If 31st March 2014 is the base date, obviously financial year 13-14 accounts will be finalized only by somewhere in September 2014. So how can I apply for 13-14 to nahi hoga, 14-15 bhi nahi hoga. So then 15-16 can I apply, sir? 15-16 can I apply? So they say voluntarily in some cases they have allowed you to do it. So because starting they should give some time. So effectively, it is applicable from 16-17 if you are a phase 1 company with the previous year column of 15-16. I repeat, I'm just telling you some extra point just to remember. It may not be a subject discussion. It is important for you to remember from which year it is applicable. What is the base date?
31st March 14.
31st March 2014. So 14 means 14-15 ko you cannot apply because obvious accounts are not filed. So 15-16 they are given you. So 31st March 2014. So 14-15 nahi hoga. 15-16 they are given you voluntary adoption in some cases. So that means effectively it is applicable from next year. Which is the next year? 14-15 nahi hoga. 15-16 voluntarily. That means from which date it is applicable?
16-17.
Can you forget now?
No, sir.
No, sir.
You are Dev. If you forget, you are Dev. I can't help it. I have given such a simple, beautiful connection. 31st March 2014, you have a love. 14th is a love date. Okay, love towards the subject. For me, love means education. Love means education. That's it. So 14, 15 nahi hoga, Dhyanesh. 15, 16 voluntarily. That means compulsorily. Phase 1 starts from 1/4/2016. 16, 17 is the first year of applicability. I hope you understood. For whom? Big, very big companies. Who is big? Sir, I'm receiving 5,000 rupees stipend. I'm big. I don't know. It all depends. For me, 5,000 is a very, very big amount. It all depends whether I'm going to temple, whether I'm going to a cafe coffee day. Correct, Surabi? If I'm going to temple, 100 rupees is a very big amount. When I'm going to cafe coffee day, 10,000 chiller, man. Let's have a party. Correct? No, it all depends. Perception matter. Correct, Surabi?
Yes, sir.
Now, phase 1 companies with effect from 1/4/2016, that is 16-17, for all listed or unlisted company having net worth greater than or equal to 500 crore. Observe the symbol equal to, very important. DT classes I was telling you. One point also extremely crucial. This table is almost like a DT. More than or equal to 500 crores. Exactly 500 crore also, I'll come under phase 1. So net worth as on 31st March 2014. It's something like your income tax. Previous year 17-18 turnover more than 400 crore. Then 30% tax rate for previous year 19-20. You know this? If you don't know, Monday you join. CFL and DT classes are starting now. Okay, so we'll discuss. So 2014, 31st March 2014 is the base date. If the net worth is more than 500 crore, you are listed or unlisted, you are a phase 1. That means from 16-17 it is applicable. Once it is applicable to you, subsequently all the years it is applicable. No second question on that. Whereas, if your net worth, not turnover, be careful, it is net worth. Net worth, balance sheet based. We are talking about balance sheet based. So if it is less than 500 crore, then it may come under 17-18 to RMR. If you are a listed company, close, full stop. That means all listed companies must come under the phase Ind AS, at least from 17-18. That's what I have tried to mention somewhere on the top. Financial 17-18, somewhere we have given an extra point there. Here. From financial year 17-18, if you can see here, from financial year 17-18, every listed company is covered. The moment you're listed company, your net worth is not relevant for me. The second small b printing, Aditi, make a note of it. Unlisted companies, net worth is greater than or equal to 250 crores. That means 16-17, correct is the correct notes. 16-17 is the first year of applicability. For whom? Whichever company, use the word only company, because Ind AS is only for companies. Ind AS is only for companies, try to understand. Whichever company, so if you're a listed company or unlisted company, net worth more than or equal to 500 crore from 16-17. If you're a listed company, if you're not coming under 16-17, from 17-18, it is compulsory, irrespective of your net worth. Have you understood or got confused?
Understood, sir.
Understood, sir.
Understood.
Only for unlisted company, if you're not come under the phase 1, you come under phase 2 when your net worth is more than or equal to 250 crores. I hope you understood. So I'll come back to the same table now. Fine. So first point is Ind AS is only for companies. Don't use the word proprietorship, partnership, LLP nahi hoga. Only for a company, public or private. So phase 1 is not based on listing. Net worth more than 500 crores, you are a phase 1, 16-17. Once you have 16-17 applicable, all the subsequent year. Akshay once married forever. Next, phase 2, if you're not covered under the first phase, come to the second phase. What is second phase? If you are a listed company but not covered under the phase 1, you are automatically phase 2 company. Your net worth is not relevant. Unlisted company, the net worth is more than equal to 250 crores. Phase 3 for other chota mota company. Over a period of time, it may happen. Okay. So as of now, we big company only, will let us look into it. That's the reason why I was telling, with due respect, most of the chartered accountants may not be handling these two big corporates. We'll be handling small, so many. Okay. So 1 or 2 companies may be there. I'm talking by the number. Okay. So for them, account standard is still applicable. So ICA standards are mandatory. Compiler standards are mandatory. You need to learn that. You need to have a knowledge about it. Fine. So same thing I given in a different way. Listed company or, okay, what is listed? There are 6 points in that. When I use the word listed, there are 6 points. Either listed or in the process of listing. In India or outside India. Either equity securities or debt securities. 6 points covered in 1 point. So listed or in the process of listing. Process of listing should be evidenced by Board of Directors resolution. Listed or in the process of listing. Then in India or outside India, then equity documents, or debt securities, anything. So if you are a listed company, either if it is more than equal to 500 crores, it comes under phase 1. Less than 500 crore, automatically comes under phase 2. If it is an unlisted company, net worth more than 500 crore or equal to 500 crore, it comes under phase 1, that is 16, 17. Phase 2 is for what you called more than 250 crore. If it is lesser than that, they are not yet notified. They are not yet notified. So please note here, phase 2, if it is a listed company, even if 200 crore net worth is there, you still come under phase 2 as far as listed companies are concerned. And once it is applicable forever. First part. Second part, JAS. So joint venture, associate, subsidiary, and holding company. This is a short form I use. Subsequently, I'm not going to discuss again and again. So you are a company, you have a joint venture, you have an associate, you have a subsidiary, or you have a holding. Once it is applicable to you, for all of them, it is applicable. That's it. There's a question in the RTP little later, I'll tell you, just based on this one sentence I made. So JAS, full Josh irbeku. JAS. Enapa? Dhanush, JAS andrena? So I take some names of the students who will respond in the class. Okay, just for keeping the class connected. I hope is all right, Dhanush. Okay?
Yes, sir.
Ella okay. Nidha ಮಾಡ್ತಾ ಇದೀನಿ ಎದ್ದಿದ್ಯಾ?
ಎದ್ದಿದ್ದೀನಿ ಸರ್.
ಅವನು ಮದುವೆ ಡ್ರೆಸ್ ಹಾಕೊಂಡು ಎಲ್ಲೋ ಹೊರಟವನೆ. I know. 3 months in the ಹೊರಟವನೆ destination, Papa. Irli. So coming back. Okay. So now when it comes to the Ind AS, okay, Ind AS, okay. Once it is applicable, I said applicable forever. Second point is, once it is applicable to you, it is applicable to all your JAS. So you may be a joint venture, you may be associate, it may be subsidiary, it may be holding company. So remember that, okay, JAS. So you are a holding company, then all subsidiary is applicable. You are a subsidiary company, it is applicable to your holding company also. So next, NBFC from 1819, it is notified. So for all companies, it is 1617, phase 1. For NBFC, 1819. So 2 years they have deferred, and then it is made applicable. Banking and insurance company deferred. Banking and insurance company, they cannot go by voluntary adoption. They do not have an option. There is no concept of, sir, I want to do it from the first year only, 16. They cannot do it because nobody understood till now how to apply for banking and insurance, probably. Next, what is this Ind AS, IFRS, etc.? So 2001 till 2001, we had at the international level IASC, International Accounting Standard Committee, remove C. They were issuing IAS. What is IAS? International Accounting Standards. But their committee was not having commitment, maybe. That's why they changed the name to IASB, International Accounting Standard Board, wherein they wanted to promulgate or issue IFRS, International Financial Reporting Standards. What is your subject title we are discussing now?
Financial reporting.
Remove the first alphabet, last alphabet. So in the middle it is there. IFRS. So IFRS is International Financial Reporting Standards. I and S, chodo. Financial reporting. So how connected you can understand easily. Next. So whatever the standards issued before 2001, so there was changes around 16 standards, and they are issued in a new avatar called IFRS. So for all of them, International Financial Reporting Standards, IFRS. So whatever the name given by the IASB, IFRS 1, 2, 3, 4, we have added 100 and made the names, numbers. IFRS 1 is equal to Ind AS 101. IFRS 2 is equal to Ind AS 102. IFRS 3 is equal to 103. Understood? So we need any new standard which has been prescribed by IASB, they call it as IFRS, we call it as Ind AS 100 series. Samajh mein aa gaya?
Yes, sir.
Yes, sir.
Whereas some other standards, for example, cash flow statement, they could not change even now. It still continues to be in the old only, IAS. So that IAS will give the same number. IAS 7 means Ind AS 7. IAS 40 means Ind AS 40. So at present, IFRS unfortunately includes 2 RMRs. Newly formed standards, the series is 100, 101 to 116. And old standard which are continued as it is at IAS, we call it as Ind AS 1, 2, 3, 4 up to 41. In between, so many standards are removed. I hope you understood.
Yes, sir.
Yes, sir.
And you must remember all the numbers here. I think except two standards, that is 104 and 106, everything is there in the syllabus. 104 and 106 is not there in the syllabus. So first time adoption, 101 first time, share-based payment, 102, 103 is business combination, 104 not relevant, 105. So non-current asset held for sale and discontinued operation, 106 not relevant, 107 and 109 financial instrument, operating segment A17. So 1 plus 7, 8, 108. Some stupid connection I used to give. 110 is consolidated finance statement. NAMA, okay, 111. That's called joint arrangements. 112 is a disclosure. So 110, 111 and 112 are related. Then 113 is a fair value measurement, extremely important. Then 114, that's also deferred, unfortunately, not in the syllabus. The regulatory deferral accounts. 115 is revenue and leases account made mandatory from financial year 2019-20. So up to here in IFRS, we have IFRS 1 to 3 series. Next, from now onwards, IAS 1 will become Ind AS 1, presentation of the financial statement. AS 2 is Ind AS 2. So 7 is cash flow statement. So like this, you can just glance it. Important ones, almost everything is important. Ind AS 10, okay, was events after the reporting date. And Ind AS 16 is what PPE. And 12, AS 22, Ind AS 12. Then 17 is lease accounting, employee benefits. 15 is AS 15 plus there actually there are 4 major categories. 15 plus 4, 19. Then Ind AS 20, borrowing cost, related party disclosure, that is the Ind AS 24. Then consolidated and separate financial statement. That's basically separate financial statement. Ind AS 27, it should be separate financial statement. Then investment in associate, the investment in associate 28. Then again 29 may not be relevant in your syllabus. 32. So financial instrument, there are 3 standards: 107, 109 and 32 financial instrument. Then very, very important is impairment. Ind AS 36, 37 is provisions. All these standards, remember the number compulsory. Then ICDS, sir, how do I remember ICDS? Income computation and disclosure standard, which is related to 145 subsection 2 of the Income Tax Act for accrual method of accounting. When the business associates follow accrual method of accounting, they must follow. Whether you're a big or small, corporate, non-corporate, income tax only, there is no such a classification. Even Infosys can follow cash system of accounting. Infosys can follow cash system accounting under income tax. Under accounts, they cannot. So ICDS mandatory for everyone who is following accrual method. How to remember, sir? Very easy. If you know AS number, 1 is same 1, 2 is same ICDS 2. Then 3, 4, etc. not relevant. Cash flow statement, why is it relevant in income tax? Income computation and presentation they want. Computation and disclosure. That's why AS7 you start. What is AS7? Construction code. After 7 till 13 consecutively numbered, but be careful with the what you call the existing standard. So 1 and 2 you remember same like ICA. Then starts directly from 7. 7 ke baad 8 nahi hai. 7, 9, 10, 11, 12, 13. All are consecutively numbered. Please take care here. 7 to 13, 7 to 13. Where 8 is not there. So 7 are there, 8 is not there. So 7, 9, 10, 11, 12, 13. Same standard. So, but you start from where? ICDS Roman number 3. So 3 to 8 are nothing but 7 to 13. Yes. Are you getting clarified or you are getting confused?
Understand, sir.
So 1 and 2 are same. Easy. I'm just trying to make your remembering easy. So 1 and 2 are same. Then from 7 you start. 8 nahi hai. 7 to 13. Give the number as Roman number 3 to 8. Then special one, borrowing cost, Roman number 9. And 10 is the last standard of ICA. What is the last standard? AS 29. So AS 29 is nothing but 10. So these are the 10 standards which have been prescribed under income tax ICDS. Now let us move on to what is Ind AS. My understanding, Ind AS is almost 95% of IFRS. Almost. So how did you get the percentage? I don't say it 94.9 bhi ho sakta hai, 96% bhi ho sakta hai. Almost. Some additional points are given. They are called carve-in. There are some deviation. They are called carve-out. Now, the interesting point is, why this carve-in and carve-out? At the 2011, we expected that India will follow IFRS as such. But later on, they realized there are so many things which are not going hand in hand with our law. For example, IFRS level, there is no concept called extraordinary item. Next, here, you know, India, so we are reasonably respecting it. IFRS level, there is no concept called deferred revenue expenditure. But in income tax, we have 35D, 35DD, 35DDA, preliminary expenditure, etc. 150 is allowed, etc. So they said it's not possible. So we'll follow you. So 95% almost same. That means when you study Ind AS, tomorrow when you get a job, so you have to follow IFRS, you don't have to hesitate to accept the job. You know, Ind AS is almost like 95% of IFRS, you know that. Plus carve-in, some additional point, minus carve-out. So carve-in, I'll just see the reverse cycle. Carve-in is nothing but additional points. When I go to Ind AS 103, now you'll understand easily because regular class happened. So 103 says acquisition method is the only method for business combination. But India says, no. When there is a common control transaction, appendix C, we can follow pooling of interest method. So they are given some additional guidance under appendix C. So which is not there in IFRS, but which is there in Ind AS. They are called carve-in, additional points. Samajh mein aa raha hai?
Yes, sir.
Sir.
Carve-out is concerned. Carve-out, what? It is not Beluru Shilabalika carving. Okay. So carve-out here means whatever has been given IFRS, we don't want to follow. Either mandatory or optional. Mandatory. What is mandatory? Whatever given IFRS, we don't want to follow. It is something like someone told me. So at IPC level. So Sorobians ansute. Sir, Shetty sir is like our parents. So Kushag Biduthu was very happy. Oh, okay. In respect upon that. Then next sentence, you know, we don't follow on that. Make it that. So really positive becoming negative, coming back. So just jokes. So mandatory standard, mandatory deviation is whatever given IFRS, we don't want to follow. Bargain another gain on bargain purchase. You can use the word. Okay, bargain purchase also we call it as bargain is in IFRS they take it to P&L account, but here we take it as capital reserve. Business combination is a capital transaction. They say you take it to P&L, but here we say no. We want to get on what you call capital reserve only. It's like mandatory deviation. Optional means IFRS would have given you 2-3 options. You say no. I want to only follow this one. So it's also called elimination of policy choice. For example, IAS 27 gives you 3 options: CFE, cost method, fair value method, equity method. Whereas India says equity method, I don't want to follow. For IAS 27, be careful, not 28. So IAS has got 3 options, but India says we will follow only 2 options, which are the cost and fair value. So optional is you're still IFRS compliant. Why you tell me? You're inside IFRS, but one of the options we are not following. I hope you understood.
Yes, sir.
Okay, right. Now let us move on to some incidental matters. Valuation of goodwill and valuation of shares. Specific syllabus of old scheme. So 8 marks to 16 marks or 20 marks. New scheme, it is not there, but it is there. It is not there, but it is there. You need to have a basic idea of valuation of goodwill and shares because compulsory it is going to be hitting you somewhere. Okay, in India itself. Okay, for example, 103. When you do the goodwill calculation, what is goodwill you should know here, basically. Valuation of shares, why is it relevant, sir? When you do again consideration, computation, etc., you should know. Compulsorily you should know. That's why I've given some basic idea. What is goodwill? SSAP 22 UK. There's a beautiful definition. It says, goodwill is the difference between the value of the business as a whole and aggregate of fair values of separable net asset. Basically, do the valuation of the business minus individually you would have done the net asset valuation. How much difference is called goodwill. So the 3 crucial words for goodwill calculation: future maintainable profit. So whatever the past profit, you take it as a base and do some adjustment of ante. Who is that ante? Abnormal items have to be excluded. Accounting policies have to be made uniform. Non-trade investment income has to be excluded and tax rate to be considered the future tax rate. First point. Capital employed or owner's money invested in the business, share capital reserves, etc. minus non-trade investment if you invested outside business. The third one is normal rate of return, risk-free return in your SFM language plus related risk premium. Then there are methods of goodwill. I have only 2 approaches. Profit-based, profit into number of years of purchase. That profit can be average profit, super profit, or annuity method. Balance sheet based, no number of years of purchase, value of the business minus closing capital employed. I'm just touching it and leaving it. Next, valuation of shares, extremely crucial. You cannot ignore these topics. So there are 3. One is based on mainly assets, net asset divided by equivalent number of equity shares. Next one is based on the profitability. So actual yield of the company divided by normal yield of the industry into paid up value. Then fair value is the average of the first two. So I am Azim Premji sir in Wipro, one of the brilliant person and great philanthropist in our country, highly respected. And one more, I was just reading about Ratan Tata ji. Ratan Tata's company has got Ratan Tata company that after Taj unfortunately happened in their Bombay attack. So two Pakistani construction companies came to bid. So they wanted to meet Ratan Tata ji without appointment. So he made them to wait, and then they said, I cannot give an appointment. And one of the politicians called Ratan Tata saying that, please get an appointment. So Ratan Tata's replied to them saying that, you may be shameless, I am not. Okay. So next, one more incident, whatever I read, how far it's true, I don't know, but should be right because he's a great person. Pakistan has given a huge order for Tata cars. So Ratan Tata said, nothing doing, not even a single car. Okay, I'll be exporting because my country is above everything else. So hats off to him. Great job. So same way, when it comes to the Ratan Tata ji or Azim Premji in Wipro, brilliant people. Okay. So then you have to go by EPS because they are the ultimate owners. Whereas I am holding 2 shares in Wipro, 2 shares in Infosys, I have to go by DPS. What is DPS? Dandapinda, whatever.
Dividend per share.
Okay. Fine. So now let us get inside. Is it boring?
No, sir.
No, sir.
If it is boring, what you know,
No,
what
sir.
isn't it? Okay. Look at the mirror. Okay, it will be inspiring, isn't it? Okay. So 2 guiding principles of Ind AS: fair value and substance or form. Fair value we'll discuss under Ind AS 113. OMM. What is OMM? Orderly transaction between the market participants on a measurement date. The general word is arm's length price, maybe section 92A of the Income Tax Act. So wherever we go, I cannot leave the connection to Income Tax Act. I don't know why it is in the blood and maybe nerves. So fair value, it should be reasonably acceptable market value. So you have to apply fair value almost everywhere. Then substance over form. Substance over form. Don't go by the mere formality. Go by the true spirit of the transaction. Sir, Shetty sir ne formal shirt nahi pehna hai. So that means I will not become a teacher. Formal shirt or t-shirt. Now you are at home online. Kya karna hai? Karo bhai. Who's going to bother? I come to the class with the panche. Okay, I come with the formal. It is ultimately, how does it matter for you? It is ultimately the substance, my knowledge, what is the limited knowledge of the subject, what I have, how I communicate, that is more important than the form. Same way, when you go by Ind AS 116, for example, you have taken an asset on lease. So how are you going to take it? Whether you are going to use it for a long period, short period, right of use asset, ROUA, we call it as. So how do you account? That's a crucial aspect. No doubt substance or form was there in AS1 of ICI, followed in a limited sense. Now you follow in an aggressive sense. In AS, almost everywhere, use the 2 words, fair value and substance or form. Every Ind AS, okay. Now when you're writing the examination, please make reference to almost every standard. Okay, whenever there is a, what you call the question, any standard, make a reference to Schedule 3. That's why I spent almost 10 to 15 minutes on Schedule 3 at the beginning. So each standard, okay, so if there is a reference about PP, you can write it is the first item or third item in format, division 2.
First type.
First item.
First item in the what you called division 2 is PP. First one sentence you get half mark, you'll get accumulation, very, very important. Otherwise, what you call losing half mark also is not acceptable. Fine. Make reference. An important point is a simple point. Every time you have to remember, you have to keep on telling again and again and again and again. I say 5 P's and 5 R's will give 5 S. 5 P's, you know, green peas, kadle, batani. What? Proper preparation prevents poor performance. So even for this session, okay, so for especially RTP I was planning to do. I was initially not planning to do RTP, but yesterday night around 10:05 I sat. Let me see how is it, Anta. Within half an hour, okay, I finished the entire 20 questions within half an hour. Okay, you can also do it. You can also, but you should have knowledge. Without preparation, if I come and teach, I will not be so confident. That's why prepare. Preparation is the ultimate key to success. So proper preparation prevents poor performance. 5 R's: read, repeat, retain, recall, and reproduce. Once you read, you'll not. That's why regular class karo, revision karo, repeat karo. There's one more plan I have. Okay, during the examination, I'll tell you this time online. Oh. Yeah, good, Danish. Acha music hai. Okay, fine. So listen. Yeah, it's okay. It happens sometimes by mistake. So when it comes to the revision, so read, repeat, because my psychology knowledge says once you read, okay, you'll remember only for a day. Twice you read, 1 week. If you read 3 times with the concentration, you'll remember for life. At least till the examination, if you remember, it is enough. So make reference to Schedule 3 every now and then. Now, basically, the accounting standards are RMPD. One more point you should know: recognition, measurement, presentation, and disclosure. These words are crucial. So you need to use the same words. One of our students, I was telling, 2 students rather, they got around 85 in auditing. Accounts 95, 98 common, 100 also is common. People have got. But 95, 85 in auditing is a huge mark. See, intermediate, yes, one of our rank holder student got 95. Okay, Priya K 95 in auditing, that's also okay. CFL 85. When I asked, they said we use the same standard, same language or the same words used in the annual report. That's why we got the what you call great mark. So try to use the same word. RMPD. What is RMPD? Recognition, measurement, presentation, and disclosure. Now, PPE, for example, India is 16. Normally valued at cost, but you can also do fair value or revaluation. Investment property, very, very important. It should always be at cost. Very important. Observe the language. So, measurement is at the cost, but within the bracket, you should disclose the fair value. Investment property cannot be revalued. It has to be valued at cost only. But so, you're right. Investment property cost 100 lakh, less depreciation. Correct. Within the bracket, fair value disclosure karo. Very, very important. Ind AS 2, cost or NRV, which are less. Look at this. All the measurement related standard I'm just mentioning. Whereas 105, non-current asset held for sale, it is like an inventory. Carrying amount or fair value less cost of sale, cost of disposal, whichever is less, like inventory. India is 41. Biological asset only at a fair value less cost to sale. So almost same, but not same. So in India is 2, I use the word cost or fair value less cost to sale, may not be right. If you use the word NRV in 105, may not be right. I want the right word in the right context. Understanding?
Yes, sir.
Yes, sir.
So India is 16.
Yes, sir.
Cost, normally fair value. You can do. Revalue investment property. Very important chart it is, because confusing item I have given connection together. This is how you should make the notes. Wherever confusion, right? There is no confusion. That's as simple as that. Okay. Normally valued at cost. Fair value is also what you called recognize. Okay, wherever you want at a regular frequency. We'll discuss that. Investment property valuation is always at cost, but disclose the fair value. Then India is 2, cost or NR, which are less, like this. Fine. With this, let us move on to each standard. India is 101. I will not waste much time. Because when you're applying for the first time, inna pandrathu, kya karna hai? So normally, okay, whenever you're applying for the first time, either the India is as such, or you're applying this standard for the first time. Till now, you are not a parent of anyone. Okay, now you have become a parent company, holding company. Then India is 110. How do you do? So normally, you need to make adjustment in the other equity. So opening balance of the reserves and surplus, etc., need to be adjusted. So this is like a transitional provision when it is applicable for the first time, or when a specific standard is made applicable for the first time. So you need to ensure that the opening balance are reasonably restated. Maybe when you go to India CAT, you will understand. Fine. So there are some exemptions. Glance it may not be so important. Next, share-based payment. Maybe recently Asha Madam would have covered it. Okay. So equity, sweat equity, etc. So whenever there is sweat equity given, you can make a reference to section 54 of the Companies Act. 53 says no company in India can issue shares at a discount. Exception, sweat equity, ESOP, etc. So the basic gist of this India is 102 is, okay, so whatever the benefit, let's say Infosys, the fair market value today is, let's say 900 for easy understanding. Whereas I'm giving to my employees at 300. 600 rupees I am foregoing because their employee, it is a deferred employee expenses. So it need to be charged to the P&L account over the vesting period. We have given some corporate law connection. I'm not going to get into that. So this share-based payment can be either equity settlement, you are going to give the equity share, or cash settle like a bonus, etc. Then share-based payment with the cash option being given. And these share-based payments are measured almost like a fair value if it is available. If it is not available, then normally you go by the market value, equity share valuation, etc. And this is like a deferred employee benefit amortized over vesting period. Next one is the most beautiful standard, Ind AS 103, a compulsory question. If there is no question about 103, maybe 4 marks, 6 marks, 20 marks, you are sitting somewhere in a biology examination of a what you call BSc. Be careful, take care of that. It must be there in the examination question. That's the kind of confidence what I have. And 100% I'm correct by God's grace. Fine. So normal business combinations can be, Jairam, amalgamation, merger, where minimum 2 companies get closed. A limited and B limited get closed. One called AB limited. Big fish is eating small limited, absorption. External reconciliation, one company getting closed and farming and more. Like Arthur Anderson, close equity. In India, we have something like Accenture. Demerger is an existing company having too many units. Separate unit is formed. Either old company is closed or Wipro continues with the software. Wipro Enterprises is continuing with the non-software. That's called demerger. Then investment in a subsidiary, that is called investment. Investment, disinvestment, divestment, etc. What we discussed. Next, internal reconstruction. It is not in a syllabus, but be careful. CA final, there is nothing like out of syllabus. So they can ask. Internal reconstruction is a company doing the restructuring of the capital and liabilities and maybe asset side. So 2 important points to be noted. After the name and reduced may have to be suffixed if the court gives the order. And compulsorily, next 5 years, the fixed asset written off has to be shown. And the last one is reverse acquisition, very important. So A limited absorbs B limited. That means A limited should be acquirer, B limited should be acquiring. But B limited takes over the management of A limited. Then legal acquirer may become accounting subsidiary and vice versa. Extremely crucial point, reverse acquisition. Take care of it. Fine. So prima facie 103 is applicable for almost all, okay, except for internal reconstruction. Internal reconstruction is not applicable. So under AS 14, there are 2 methods of amalgamation. Jairam, amalgamation in the nature of merger, amalgamation in the nature of purchase, for which 2 methods of accounting, pooling of interest method and purchase method. Under Ind AS 103, there is only 1 method of accounting, that is called acquisition method. However, Appendix C to 103 gives a carve out from IFRS 3, which talks about common control transaction, merger of fellow subsidiaries, merger of 100% subsidiary with the holding company. There you can follow pooling of interest method. So normally purchase method or acquisition method at fair value, no goodwill concept here. Okay, sorry, goodwill comes into picture under the acquisition method. I'm sorry, goodwill comes. But goodwill cannot be amortized. There is no concept of, there are 2 points you should note down. Okay. So whenever there is an Ind AS 103, point number 1, note down wherever viewer is writing. 103, goodwill arises, no doubt. Goodwill arises, but there is no concept of amortization of this goodwill. Goodwill is always impairment under Ind AS 36. Second point is, for such goodwill, there is no creation of deferred tax asset under Ind AS 12. The 2 points, you please note it down. Okay, Aditi, note it down. So for goodwill, are you listening? No amortization concept, only impairment test. Understanding?
Yes, sir.
And second point is, Ind AS 12 cannot be applied as far as goodwill is concerned. Then capital reserve, IFRS 3 says it's P&L. Here we call it as a gain on bargain purchase, ultimately shown under OCI, other comprehensive income. So the deviation from IFRS, there's a carve out. I'm connecting now again and again. If they ask you, old scheme, what is the difference between AS and Ind AS? Or Ind AS carve out, you can write. Common control transaction, we can follow pooling of interest method. And here, difference, listen carefully. AS 14, pooling of interest method, any difference, positive or negative, is adjusted in the reserves, they say, which is normally profit is a general reserve, loss is a capital reserve. But Ind AS 103 prakara, common control transaction, pooling of interest method must be taken to capital reserve only, which can be negative also. Please make a note of it. Are you comfortable with this pace? Not face. Face you can't change. Pace.
Yes, sir.
Yes, sir.
Okay, right. Next. So mainly acquisition method is considered for purchase method and pooling of interest method, blah, blah, blah. Okay. So now there are 2 important methods of computation of goodwill. Extremely crucial when I go to 110. Vodama, Surabhi. Just I can save some energy.
Yes, sir.
Yeah.
Mainly, acquisition method is considered for purchase method of amalgamation and pooling of interest method for common control transactions. Goodwill or NCI computation, total goodwill method, consideration paid plus NCI at fair value of all net assets.
Yeah.
Minus.
I'll add
Minus.
See, this is what the problem I always tell my students. See, I gave only one chance to the student in last 1 hour. Allu, you don't read what is there to be read. Read what is there to be read. Don't read what you want to read. So, assuming I acquired 80% consideration paid plus NCI, non-controlling interest, that has to be valued, minus fair value of all net assets of that subsidiary company. So, these are total goodwill because you are going by total approach. Whereas right side, partial goodwill is 80%. How much is the consideration I paid? Whatever, minus is equal to Aditi, minus fair value of the net asset acquired, okay, net asset to the extent what you hold. So 80% consideration minus 80% of the net asset. That is called partial goodwill method. So be careful, it is relevant for 103 as well as 110. Total goodwill method, whatever the consideration you paid, 80%, plus NCI, add karo, so it become 100% consideration, minus 100% of the net assets, fair value. Next. Now, sir, for the total goodwill, now NCI, how do you value? There are two approaches. NCI may be measured at fair value or it can be proportionate of net assets. I repeat, extremely important. You can go by total goodwill approach or full goodwill method. Consideration paid plus whatever the NCI, that also add karo. That will become 100%. That's why minus 100% of the net assets of that subsidiary company or acquisition, the company which you acquired. Here, the NCI, how do I value? Either fair value or proportionate of net assets. Partial goodwill method, 80% you have paid minus 80% of the net assets. I hope you are understanding.
Yes, sir.
And common control transaction,
Yes,
where
sir.
you can go by pooling of interest. These are the examples. Mergers of fellows, Appendix C to India's 103, Appendix C and the Aditi. So, merger of fellow subsidiary, merger of subsidiary with the parent, blah, blah, blah. Next, purchase consideration. Very, very important. Consideration is the word used. Whatever you pay to the transferor company, mainly to the shareholders of that, for acquiring their stake. This comes under 110 as well as 103. Because 103 is like acquiring B Limited. 110, I acquire shares of B Limited, by which it becomes a subsidiary. So normally, whatever consideration you pay, if there's a deferred consideration, we say we'll not pay now, we'll pay after 1 year. Then you go, consideration should be valued at a present value, not fair value. Be careful, present value. Discounted cash flow, whatever is the future cash flows, convert into today's value. Okay, here whatever you are going to pay, convert into today's value. Like 10 lakh rupees I'm going to pay after 1 year. So today it's something around 9 lakh if you go by 10% discounting. So very important again, such consideration, now you know 109, such consideration is classified as equity, shall not be remeasured. If it is equity related, there is no question of remeasurement. Subsequently also continues to be with the equity. If it is other than that, it is not other contingency. I'm sorry, it is the other consideration. As contingency is take up money. Other consideration that is other than the equity, it is measured at fair value at each reporting date. Any change in the fair value should be recognized in P&L as per India's 109. I repeat this. Whenever there is a deferred consideration, it has to be discounted to today's value. Such consideration shall be classified as equity. Then it cannot be remeasured. Equity means you will not remeasure. Yeah, that's it. It's like a permanent one. If it is other than equity, let's say debt, etc., then it should be measured at fair value each reporting date. So earlier it was 100 lakh. Today fair value is 120 lakh. That 20 lakh has to be transferred to P&L. Fair value through P&L. FVTPL. FVTPL. Asha madam has discussed this in the regular class.
Yes, sir.
Yes, sir.
Yeah. Next. There is a small present chart mistake which can you correct it later and give you. Contingent consideration, this should be valued at a fair value. So what is the fair value of that contingent, which may be given based on the uncertainty of the future events? It has to be measured at the fair value. So deferred consideration PV, then contingent consideration FV. It is may or may not. That's why it is going to be recorded at a fair value. Yeah.
Fair value.
Recorded at fair value. Fair enough. Okay, right. Come back. So and that's the chart. That chart is all right. That chart is all right. There is no confusion about the chart, but only the yeah. So this is the present value. So contingent consideration Fair value, okay, this chart is all right, perfect. Then, so in case of demerger, this is important, extremely important. Okay, so if you want me to repeat the discussion, I'll repeat about that consideration. Consideration, yeah, consideration, deferred consideration should be recognized at what? Present value. Contingent consideration, at
Fair
fair
value.
value. And fair value, if it is equity, there is no remeasurement. Other consideration, okay, it can be remeasured at fair value and it has to be taken to P&L. Fine. Next, in case of demerger, it is also covered under 103. Transfer company, any loss transferred to P&L, because Ind AS is mainly applicable to the transferee company. Exceptional cases, liability transferred is higher than the assets. Net liabilities transferred is higher than the assets. Aditi, profit to be transferred to capital reserve. Whereas transferee company, it is normally goodwill or capital reserve. Goodwill or capital reserve. And such goodwill, what you should do?
Test for impairment.
Very good. You should always test for impairment. Okay. But entire Ind AS 103, any profit is transferred to capital reserve. I have given that. Common control transaction, I was telling you, Appendix C to 103, that same discussion what we had, we have just repeated that point. Fine. Ind AS 105, 2 RMRs. It discusses about non-current asset held for sale. So what is current, what is non-current? So for current asset, okay, the definition is ITC mainly. ITC, inventories, trade receivable, cash and cash equivalent. An asset which is used in the manufacturing cycle, normal operating cycle, receivables, which is normal receivable within 12 months from the reporting date. Be careful. April sale, September sale, March sale. 31st March, from there you should take 12 months, not from the date of sale. Then cash and cash equivalent, they are always current. And which comes within your operating cycle. Operating cycle is very, very important. For a bakery businessman, operating cycle may be 3 days. For a ship construction, it may be 4 years. Whatever is getting converted into operating cycle, so cash, raw material, work in progress, finished goods, debtors, cash. So this operating cycle, whatever is getting routed through here is called current. Everything else is a non-current. So 105 is applicable only for non-current. First, non-current is basically, example can be fixed asset. That fixed asset, which should come under Ind AS 16, if you are removing it and held for sale, it comes under 105. So first point, use common sense. Sir, inventory held for sale comes under 105. I'm stupid if I say that. Why? Because it is held for sale only. Our inventory is meant for sale only. If it is a non-current asset held for sale, it comes under Ind AS 105. Arthakta idea?
Yes, sir.
Yes, sir.
So non-current asset. So non-current assets are assets which are not current. So current asset you understood. Other than current, it is called a non-current. Disposal group. There is a special definition. The group, the unit which has been meant for sale in the short period. It may be a special cash generating unit, CV. Right. So it should be measured at given the definition here. Okay. So 1 second. Yeah. So in non-current asset held for sale should be valued at carrying amount or fair value less cost to sell, whichever is less. So measurement, it's here. Okay, I was just searching for this word. Carrying amount or fair value less cost to sell. This is the left side, discontinued operation. Whereas non-current asset held for sale. Next, if it is a discontinued operation, the word used is discontinued operation. For example, Wipro has discontinued their non-software activities. It has to be shown separately in the statement of P&L. In the P&L, okay, so P&L starts with the ROTE, revenue from operation, other income, total expenditure. So in that, okay, there is a separate heading called discontinued operation. If you are discontinued, what is the profit on discontinuation, what is the tax impact, etc. has to be shown. So this also you have to make reference to schedule number 3. Fine. So non-current asset held for sale is valued at carrying amount or what? Fair value less cost to sale, whichever is less. Discontinued operation make a reference to part 2 of the schedule 3. Part 1 is the balance sheet. Part 2 is the statement of P&L, and pre-tax and post-tax profit has to be disclosed. And very important, you remember this chart. It is not applicable for current asset. It is by name only. And also certain non-current asset like financial assets, because they are already covered on 109. Deferred tax asset covered under Ind AS 12. Then assets arising from employee benefit, it's covered on 15. So normally, anything which is specifically covered under any other standard cannot be covered under a what you call general standard. Arthak idea.
Yes, sir.
Next, Ind AS 108. Extremely beautiful and important. Expected question. Almost every exam. Operating segments. Year 17. Reportable segment. Reportable segment we say is operating segment. So Wipro has got, let us say, 100 items. Whether there's a profit or loss in each item or each area, how do you know? Prepare a columnar P&L balance sheet. Departmental account, altered name is called reportable segment. So which is reported? Every 100 items karna hai? That's not possible. Okay. In Mahabharata, 101 children, I think Dhritarashtra and Gandhari had. But which is the most important characters? Duryodhan, what is the name? Dushasan, like around 3-4 used to, etc. So special names. Everybody was not given the same importance. So same way, you got hundreds of products. Every product you cannot keep on reporting. So three important criteria: 10% or more. My presentation is very perfect. More than 10%. 10% or more of what? Total revenue. If any segment contribute for 10% or more of the total revenue, when I say total, Aditi again, internal and external sales, merge karo. Next, second one is 10% or more of the results. What is results? Total of all profits or total of losses in absolute term, whichever is higher, or 10% or more of all the assets. So all the assets should exclude fictitious assets. You should also exclude income tax assets. Okay. I hope you are noting down all the special part. So any segment which contribute either under the revenue category or under result category or under segment usual. That means assuming there are 6 divisions or 6 units or 6 products. So out of that, ABC comes under first category. Then you don't have to check second category as per ABC. They are reportable segment. That's it. If they do not come under the first criteria, go to the result. So maybe D comes under second category. Whereas if they don't come under first and second, then E and F check only in the third category. So reportable segment can be either revenue based or result based or asset based. Once it is a reportable segment for 1 year under the 10% criteria, compulsorily you have to report the same in the next year. Minimum 2 years. Current year plus next year karna hi hai. Now very interesting. Let us assume Wipro has 20 products. Each one of them contribute 5% of the revenue, 5% of the asset, 5% of the result. That means none of them will become a reportable segment because of 10% criteria. So then entire objective of reportable segment goes to toss. Then immediately say, no. Whatever may be the case, minimum 75% of your external revenue should be external. Here I'm using the word only external revenue should be covered under the reportable segment. So first case only, I said 10% or more of all external internal transfer. Here minimum 75% of the external revenue should be covered. Let us assume you have got 6 products. A, B, C contribute only 60% of the external revenue. Identify any other segment, whichever you want. Ensure that at least 75% external revenue is covered. That means Roman number 1 and 2 are must. Whereas this A or B or C. Apart from that, assuming you are starting a new product, so it may be contributing only 2%. Now it may be 2%. Tomorrow it may become very big. So management wants to decide and show extra. They can always report extra. In Ind AS and account standard, more is never less. More is never less. Unlike Salman Khan and Malika Sherawat. Fine. Then, so very important also for reportable segment, identifying a function, the CODM, Chief Operating Decision Maker. It is not a post given, it is a identifying the function. So here, I've already told you, okay, whether the component is able to earn the revenue, yes, sir. So is it regularly reviewed by the CODM? So etc. Then you have to go for reportable segment based on the 10% criteria. Now, can I combine the operating segment if they are consistent with the principal character, etc.? You can. Otherwise, you should not combine the operating segment. For example, sale of pant and shirt comes under textile, you can combine. But pant is exclusively for export purpose and only online. Shirt is only local market offline. Then probably you may not be able to combine. Fine. Then segments can be either primary or secondary based on the risk and return. So it can be either business segment or geographical segment. Geographical can be based on the location of assets. Like I have one unit in Coimbatore, Goa, Andhra Pradesh, Tamil Nadu, etc. When or based on the location of customers, like BPO call centers, all of them working in one building for the different level of customers. 108 is basically a disclosure standard. Okay, so fine, that should be all right. Next, 109, a very big standard. Recently, it's happening or happened. I don't know. As I may not go too detail. Basically, it is talking about financial instruments. Financial instruments, the definition of financial instrument, financial instrument, financial liability. Directly connected to Schedule 1, balance sheet part 1. Huge discussion there. So basically, any asset which is reasonably convertible into cash and cash equivalent in whatever form. Now, when I talk about investment in shares, an easy answer, it is a financial instrument. Debtors, how is it possible, sir? So debtors, there is a concept called debt securitization. In FM, you learned. So it can also become a what you call financial instrument. There's a beautiful concept table given. Just glance it. I've learned. So FET PL or FET OCI. Fair value through P&L you may do. 109 mainly talking about these 2 points. Fair value through PL or fair value through OCI. And again, if it is a combined security, debt security, equity component, embedded derivative, how do you segregate? All by using your FM knowledge. These are beautiful. So look at this. Financial instrument is a contract that gives rise to both financial asset for one entity, financial liability or equity instrument for another entity. For example, A Limited issued shares. For A Limited, it is an equity. Whereas Akshay purchased the same. For him, it is a financial asset. That is nothing but investment. So this is a definition you should go through. And in a traditional balance sheet, what is financial asset? What is financial liability? We are given. Fixed assets cannot be. There is a traditional balance sheet. It is old balance sheet. Liability side is used to say, Sri Ramaswamy uncle came late to party anta. Share capital, reserve surplus, secured loan, unsecured loan, current liabilities and provisions. So when it comes to fixed assets, all fixed assets are non-financial instruments. Investment, etc. Yes. Investment property is again like a fixed asset. It is no. So please go through this chart. Important. Inventory as such is no. Most of the other trade current assets are yes, including cash and bank. The liability side also, please go through this balance sheet. Beautifully done. Okay. I'll not go too much. Derivatives, again from SFM. Okay. So derivative. So a loose example. So maybe buttermilk deriving its identity from the curd. This is called buttermilk. Okay. So how do you account for the same? That is also discussed. Hedging. Hedging is basically covering the risk. So I'll not go too detailed because it's a big standard. It has been recently concluded and reasonably important. One more compulsory question. Most of the time, first question. CFS. Cash flow statement. Consolidated financial statement. I'll not get into the corporate aspect. I'll just touch it and say 246 defines holding company. 287 defines what is subsidiary company. Majorly from accounting point of view, more than half of the voting power, mainly equity shares, mainly or convertible preference shares which have a voting right, and more than half of the composition of board of directors. Section 19 prohibits subsidiary company from purchasing the shares of holding company because otherwise you'll have a confusion. 129 subsection 3 deals with what? Consolidation. 129 subsection 3. Format is similar to normal format of a company, standalone financials. So for consolidation, I have made 6+2 steps. Very important. So parent acquiring, let us say 80% stake. So financial year in 1920. So parent acquiring 80% stake in shares of subsidiary company. Shares are estimated, that's why it becomes subsidiary company. Let us say on 1st January, financial year 1920, throughout my discussion today. So what should I do? Step number 1, determine the shareholding pattern. Mainly consider equity shares. 80-20 or 4:1. Very important for the second step. If there's a bonus issue, etc., take extra care. So H Limited has made a bonus issue considered by H but not considered by S, or vice versa. Take care of it. Bonus shares, also called capitalization of profit, section 63, giving free shares. In the books of issuing company, reserves debit share capital credit. In the books of the investor, no entry because it's a free share. Nai Mari Akidre entry illa. There is a free share what you're getting. So step number 1. Step 2 is the crucial step. Step 2, if you do correctly, 90% of consolidation is done. Step 2 is based on a principle. No one can make profit without being in existence. It is a statement. No one can make profit without being in existence. At CAPS, we do a lot of inspirational philosophical statement. So this is one such statement I want to make. No one can, you are not born, you made a profit. It is rubbish. How can it possibly happen? So H Limited acquired 80% on 1st January. So first 9 months, it was never the owner. Only next 3 months in that financial year is the owner. Understanding?
Yes, sir.
However, corporate law says somewhere in August, record date, when they issue so when they make a dividend declaration, they say, who was the owner earlier? I cannot keep a track here. Especially public limited listed company shares are easily transferable. How can I keep a track of it? I cannot keep a track of all these things. Whoever name appears in the register of members, give him the dividend. Give him the dividend. So even though H Limited was not the owner for the first 9 months and earlier years, whatever the other equity lying in the balance sheet, H Limited is made eligible. So that is why, whatever the reserves, assuming 31st March 2020, CBS date, if the amount lying there is 400 crore, so 2 RMRs. What was the profit made by H Limited up to 1st January 2020? That the opening balance in reserves and surplus plus current year, listening? Current year profit for 9 months. That's called pre-acquisition. So from pre-acquisition, you can reduce the bonus shares, then 2 RMRs. Whatever is belonging to holding company, you call it as A1. Subsidiary company, NCI is called B1. So whatever the profit visualize, only if you attend the regular class, you'll understand this. Otherwise, it's not so easy. So 31st March 2020, subsidiary company has got 400 crore reserves, other equity, 2 RMRs. Pre-acquisition up to 1st January, let's say 300, under that 2 RMRs. Holding company stake, NCA stake. Call it as A1, A2. Post-acquisition right side, whatever is the profit from 1st January to 31st March, post-acquisition reserve separately, P&L separately, because line by line you do. And if there's a depreciation on revaluation minus karo, that profit 2 RMRs. Left side, holding company stake, green ink B1 double box. Do you recall that?
Yes, sir.
And B2 is NCA. Then, if there's a bonus issue, show separately 2A, fair value change, revaluation, do it 2B. Again, do RMRs, holding company NCA, holding company NCA. So, share capital in step 1, share capital of subsidiary company, everything is a subsidiary company, is called holding company X1, so NCA is called X2. Then reserves and surplus, the next item. So, share capital reserves surplus covers the entire equity. So, pre-acquisition, post-acquisition, A1, A2, B1, B2, bonus share C1, C2, then revaluation profit of fair value change, D1, D2. Then step number 3 is computation of goodwill. It depends on 1 or 3. Total goodwill or partial goodwill, go and refer. NCA computation also depends on that. Step number 4, if it is a total goodwill method, whatever NCA you considered in goodwill plus B2 from the date of acquisition, because NCA computation is on the date of acquisition for the purpose of 1 or 3. Arthak idea?
Yes, sir.
Plus
Yes, sir.
for the next 3 months, what you did, because consolidation is on 31st March. Whereas partial goodwill, all 2 series you add. X2, A2, B2, C2, D2, everything you add. समझ में आ रहा है?
Yes, sir.
Next, step number 4.
Yes, sir.
H Limited and S Limited, intercompany owings, debtors, creditors. They sold goods and purchased the goods, BR, BP, all those you minus. So one special point is, BR in H Limited is nil, BP in S Limited is 10 lakh. They say this entire 10 lakh belongs to H Limited. Then intercompany owings to be deducted is nil because H Limited would have discounted this bill with someone, or if they would have endorsed. That's why whichever is less. Unrealized profit. So downstream and upstream. Holding company selling goods to subsidiary company, do it in step number 6 only. Whereas upstream, subsidiary company selling to the holding company. Listening?
Yes, sir.
Yes,
That
sir.
should be adjusted in Roman number 2. Step number 2 only you should adjust from the post-acquisition profit you minus karo, then 2 RMRs. Yeah. And consolidation interlinks. CFS is 110, joint arrangement 111, disclosure requirements are given 112. India's 27 separate financial statements, and investment in associate is also covered here. Next. So Ind AS 28, which is connected to this directly done, it covers entire AS 23, accounting for investment in associate in CFS, and part of AS 27, that is jointly controlled entity, and follow equity method. Fine. Then goodwill again we have discussed here. Next, interconnections. Just glance it once. Okay. Fine. Further, for the right term to be used, assuming there is no holding subsidiary concept, you should use the word individual financial statement, IFS. When there is a holding and subsidiary, then they are called separate financial statements. Please remember H Limited and S Limited, if there is a holding subsidiary, 129.3 read with 129.1 says Holding company separate financial statement has to be filed. Subsidiary company separate financial statement has to be filed. Consolidated financial statement in addition has to be filed. Along with the AOC one, there's a statement relating to how much is the percentage holding, etc. That also you go through. Then obviously CFS. So when there is no CFS, they are called individual financial statement. Otherwise, they are called SFS, separate financial statement, and what you call consolidated financial statement. Steps. So all the steps what I discussed are absolutely same for AS 21 also, but use the word which are used in Ind AS. Fine. Fine. So there are two methods of accounting for investment. One is called cost method. Basically, AS 13 talks about that. Cost of purchase plus incidental expenses minus dividend, etc. if it's a company. Equity method is nothing but partners' capital. Myself and Surabhi are partners in a firm. In the partnership firm, what is the partners' capital shown there? How much of the investment made plus any share in any profit. Remember, revaluation profit, revenue profit, whatever you take, minus drawings we call there, minus dividend. So very easy. Cost of purchase plus or minus share in profit or loss, any profit minus dividend. It comes little later. The differences you just glance it. Just for old scheme and new scheme, I can go through it. Next standard, I'm going in the Ind AS order only. 113, fair value measurement. Fair value definition, I said OMM. A transaction for sale and purchase in an ordinary transaction between market participant and measurement. This crucial word, punch word I call it as, you must remember. Principal market is where the greatest volume of transactions is happening. And what is the most advantageous market? This is also very important definition, go through. Fair value, you can have three approaches. MIC, market value approach based on the market price. Income approach, future cash flows converted to today's value. Cost approach, go by current replacement cost. Then which fair value you have to consider? So it can be level 1, very important words. Level 1, level 2, and level 3 inputs. Identical adre, go by level 1. You have identical product available. This t-shirt and one more t-shirt, which is absolute. This is blue color. There is black color. What Surabhi is having a blue color. It's identical. So you can go by it. Similar means, so they are not exactly same. It's little difference. Similar. So level 1 input, I give an example, government securities. Compare with another government security. TCS and Infi are similar, unabsorbed, where you don't have a comparison at all. Okay, a new product which has come in the market, no comparison, then you have to go by a mathematical calculation, maybe by using some techniques of valuation. One more compulsory question: revenue from contract with customers. So AS7 and AS9 are merged. So earlier we had Ind AS, two Ind AS for the what do you call AS as well as Ind AS. Now they are merged into 115. Name only says contract with customers, including construction contract covered. It covers all kinds of provisions. 5 steps model. There are 5 important steps. So we read.
5-step model, COPER. Identify the contracts with the customer. Identify the separate performance obligations in the contract. Determine the transaction price. Allocate the transaction price to the separate performance obligations. Recognize revenue when or as the entity satisfies a performance obligation.
So these 5 points are extremely crucial. COPER, 5 conditions are satisfied. The 5th condition says recognize the revenue. Identify the contract, performance obligation, transaction prices. Each point is very important. Every question of the study material to solve because they'll be lifting the question from there. And can I combine? So building construction contract and architecture contract, can I compare? Yes, if they are having a similar what you call characteristic features and they are interdependent to each other. Can I modify the contract? Yes, provided they have what you call the agreement in writing. Disclosure requirement like any other contract. Fine. India is 116, extremely important. Recently introduced though, so a definite question in the exam. Lease is at the inception of the lease, an entity shall assess whether the contracts are. A contract is or contains a lease if the lease, okay, lease definition. If the contract conveys the right to control, right to control the use of an identified asset for a period of time in exchange for a consideration. My asset, I'm giving to Surabhi for doing some activities there. That is what is called lease. So very, very important. In the books of the lessor, there is a concept of operating finance lease even now. Shamiana, I am a owner of Shamiana. Surabhi's marriage, I give for 2 days. In my book, I am the lessor, I am the owner. Everything is related to me, including depreciation. Whereas finance lease, I am a seller of cars, Tata Motors. So Dhyanesh is the purchaser of the car. Finance lease, that is finance lease. So in the books of lessor, there's the concept of operating and finance lease. In the books of lessee, there is no such concept now. No such concept now. It is only the new concept, right of use of asset and lease liability. So in the books of the lessor, this table please go through. In the books of the lessor, if it's the operating lease, Shamiana, for me, lease rental is an income. I can claim a depreciation. I am the owner. It is a PP. Whereas if it is a finance lease, recognize the finance lease receivable, which is mainly present value of the minimum lease payment and interest income has to be separated. In the books of lessee, there is no operating finance lease. Right of use of asset on the asset side and lease liability on the liability side is basically present value of lease payment. And depreciation can be claimed on right of use asset if it is reasonably long term. So interest expense, lease liability. So only exception here is if it is a small value or extremely short term. So then right of use asset is considered whatever amount you pay, it goes to P&L account. Fine. So the same thing we have given in a table form. Go through. One extra point is sale and lease back. Now I am the employer. Surabhi is the employee having 50 lakh worth of Mercedes-Benz car. What is the use of having a car? Because income tax doesn't give any depreciation benefit under salary chapter. So she sells the car to me, seller. I am the buyer. I lease to her. Buyer becomes the lessor. She will become the lessee. So lessor can claim depreciation under income tax. Circular number 2/2001. So I can get extra depreciation benefit. That depreciation benefit, I can reduce the tax. Who knows, I can increase her salary also, which is also tax deductible. So till now, whatever the standard we discussed are IFRS 1 series, which we call it as Ind AS 101, 102, 103, etc. All consecutively numbered, out of which 104 and 106 are not applicable. All of you are comfortable?
Yes, sir.
Fine. So let's continue for some more period of 15-20 minutes. Then I think we'll take a break. Comfortable?
Yes, sir. Yes, sir.
So Ind AS 1, now I think some of them are very, very easy. I'll not go too detail. Presentation of financial statement. Whatever we discussed, financial statement, cover 240 within bracket 120, section 129, schedule 3. So part 1, division 1, division 2, etc. What I discussed. Going concern is important. If going concern is affected, your financial statement has to mention and accordingly you have to prepare. Accrual is one of the fundamental accounting assumption. Consistency also followed. What are the financial statement? We already discussed at the beginning. Just glance it. Inventory, very, very important. Inventory, because you studied good number of times, I'll not go too detailed. Inventory mainly consists of raw material, work in progress, finished goods. In addition to that, stores and consumables, etc. So the work in progress and finished goods are normally valued at cost or NRV, whichever is less. Cost or NRV, whichever is less. Raw material is normally valued at cost, unless NRV of both raw material and finished goods, important point, are lesser. Then Ind AS 2 says you have to value the inventory exclusive of GST credit, exclusive method, unlike 145A of the Income Tax Act, okay, which talks about inclusive method. Very crucial point. This point I always expected example. Variable overhead, always a portion based on Aditi actual production, actual production. Fixed overhead, if the actual production is more than the budget, assuming 10 lakh units expected, I manufacture 12 lakh, then you cannot charge more. That's why you have to absorb based on actual production. Whereas if the fixed overhead, actual production is lesser than the budgeted or the normal production, it is always based on budgeted production or normal production. There's a question in RTP, wait for some time. Okay, the same example. Okay, it is here. Just go through it. So budgeted production 10 lakh, actual production 8 lakh. Variable overhead is always based on 8 lakh, no confusion. Fixed overhead is 100 lakh. Closing stock. Variable overhead is always based on 8 lakh, I said. Fixed overhead, here actual production is lesser, it is based on 10 lakh. If actual production is 12.5 lakh, then fixed overhead should be based on 12.5 lakh. I hope you're understanding. Extremely important point. And NRV of raw material should not be considered unless NRV of both finished goods and raw material are lesser. Next, cash flow statement. So it is a representation of the balance sheet and P&L under operating, investing, and financing. What is operating? Principal revenue producing activity and other than financing and investing. What is financing? So any change in size and composition of equity and borrowing of the enterprise. Investing is any cash flow arising from long-term asset. So I simply say, balance sheet okay. So I simply say anything related to the fixed asset and investments other than cash equivalent is investing activity. Anything related to share capital, security premium, and borrowings is a financing activity. Everything else is a operating activity. Go through, it might be asked for 4 to 6 marks. Extremely important. So operating activity, investing activity, and financing activity. That's the way. And this is a para number of AS3, not Ind AS. I'm sorry. Operating cash flows can be direct or indirect. Operating cash flows can be direct or indirect. All of you? Direct,
Yes,
sir.
direct
Yes,
deposit
sir.
and payment. Indirect means start with the net profit and do the adjustment for the same. Next. Ind AS 8, discuss with the 3 points. Accounting policy. Note Koli, AS file changes in accounting policy. Here we use the word accounting policies. Extremely crucial. The principal policies and practices which are followed while preparing and presenting financial statement. This is the definition of account standard. Account standards are 5 P's. Principal policy and practices while preparing and presenting financial statement. So, accounting policies you have to disclose. If there is any change in accounting policy, it has to be done retrospective effect. If there is a change in accounting estimate, it is always prospective effect. And errors, earlier, prior period item is the word used in AS5. Now the word used is errors. Errors includes misinformation also, it includes fraud also. It has to be given a retrospective either application or retrospective restatement. What does it mean? What does it mean of retrospective application? Assuming 4 years back it has happened. From 4th year back, you recalculate and bring that balance this year. That's called retrospective application. Retrospective restatement is only opening balance. You are changing and doing it. Fine. So very important as far as PP is concerned. Now, anything related to PPE, anything very important point, anything related to PPE is a change in accounting estimate. So SLM to WDV is also accounting estimate. Estimated useful life change is also accounting estimate. It has to be done prospective effect. Only exception to this is you normally value PP at cost. If you value at fair value, there is a change in accounting policy, but it's specifically covered in Ind AS 16. So it has to be prospective only. That means anything related to PPE now, it is only prospective effect. Yeah, I've given the explanation. Yeah, this is what I've given. Change in accounting policies and errors, always retrospective effect. Accounting estimate is all prospective effect. And depreciation is always a prospective now. Ind AS 10, events after reporting date. 31st March is my reporting date. My financial statements are approved by the Board of Directors of the Governing Council on 30th June. In between 3 months, if the transaction happen, so they are either called adjusting event or non-adjusting. Very crucial. If it has to be adjusting, the condition should be existing as on that 31st March. As on 31st March. Then you have to go back and change the figures in 31st March. Whereas if there are new event, but made known to you later, it is only a disclosure, especially if the going concern is affected. Going concern also you make a reference, otherwise not. And there is a separate discussion as per the proposed dividend now. Proposed dividend is now non-adjusting item. It is not adjusting item, unlike earlier AS5, which was a adjusting item. And very crucial, when you talk about the adjusting, now an example repeatedly asked. 10th April fire occurred, because of which actually there is a huge loss to the customer and it became a bad debt to us. Even though it is on 10th April, it occurred because of the fire. Fire didn't happen on 31st March. It is not an adjusting item. Accrual is the fundamental accounting assumption. It should have accrued on 31st March. Then only you can be called adjusting item. Are you able to understand and recall?
Yes, sir.
Yes, sir.
I'll go those are easy standard. I went a little fast. This is little standard. Income tax. So basically under AS22, you have a concept called permanent difference and what you call a timing difference. In Ind AS 12, we call it as a temporary differences. P&L account, net profit as per P&L 100 lakh. Add back girlfriend's ice cream expense. That will never be allowed in any year. There is always a permanent difference outside this standard. Whereas net profit 100 lakh after debiting bonus to employees 40 lakh. Bonus is paid after the due date under 139(1). It is not allowed this year. It is allowed in the next year. This is called temporary difference. So what you should do is, in AS 12, all assets and liabilities, find out the carrying amount. 2 points you should know. Carrying amount is the amount in the books of account. Whereas if there is a business acquisition under Ind AS 103, the fair values what you recognize itself will become a carrying amount. But for income tax purpose, section 2 within bracket 1B, read with section 43 subsection 1 and 43(6). When A Limited absorbs B Limited, whatever the WDV in the books of transferor company will become a WDV in the books of transferee company, subject to certain conditions. That means tax base won't change. So in the books of transferor company, tax base is, let us say, 100 lakh. The carrying amount has been changed to 120 lakh. So 20 lakh is the difference. That difference is called temporary difference. Now, very simple approach. You are in FR subject, be loyal to FR. Carrying amount is as per the accounts. If carrying amount is 120 lakh and tax base, that is as per the income tax is 100 lakh. 120 minus 100, it is a positive balance. Fixed asset always shows a debit balance. That's why this 20 lakh is called debit balance, leads to deferred tax liability. On 20 lakh, let's say 30% tax. So when it comes to the Ind AS 12, your carrying amount is 120 lakh. Let's say fair value of the asset recognized. And the tax base is 100 lakh. 120 minus 100, you get to 20 lakh positive. Asset shows a debit balance. Since it's the debit side of the P&L account, it leads to deferred tax liability. P&L account debit to DTL. Ulta. Carrying amount is 100 lakh. Tax base is 120. 100 minus 120. 20 lakh is the credit balance. Comes on the credit side of the P&L account. Deferred tax asset. So easy. Expenses come on the debit side. Income comes on the credit side. This is the sum and substance. And you need to go by the latest available tax rate. So even though Finance Act 2019 is applicable for 1920, for deferred tax, you have to go by Finance Act 2020 because the tax rates are either enacted or substantively enacted. So I said that differences, debit balance bandha, it's called taxable temporary difference. You have to create a deferred tax liability. If it is deductible temporary difference, you have to go for deferred tax. I given the list of the examples of permanent difference, which is outside the Ind AS 12, and temporary difference. Temporary differences are a difference which arises this year, gets reversed in one or more subsequent accounting periods. Fine. So also for the account standard 22 angle, you can go by this approach. This is mainly for account standard. So provision for tax is always based on income tax income. Net debit to P&L account is always based on accounting income. Difference 2 minus 1 is called a step number 2 minus 1 is called deferred tax liability. Okay, it's ulta bar correct. Step 1 minus step 2 is called deferred tax asset. Fine. Goodwill itself is a temporary difference under in 103, and Ind AS 12, very important, prohibits the deferred tax recognition for the same. Compulsory issue and deferred tax and asset and liability is always non-current as per part 1 to schedule 3, division 1 or division 2. Same. Next, one more beautiful but very important standard. So PPE, mainly tangible asset, which is intended to be used for more than 12 months. Okay, the definition is here. It excludes, exclusion and inclusions are important. Okay, so it is here. Ind AS 16 is not applicable to biological asset. What is biological asset? Which has a life, either living animals or plants, but it applies to bearer plant, but not produced from bearer plant. Confusion? I'll explain. Ind AS 16 is not applicable to dogs, etc. No confusion. It is also not applicable to rubber plant. But if it is a bearer plant, what is the bearer plant? Definition I have given here on the top. A bearer plant is a living plant that is used in production or supply of agricultural produce, expected to bear the produce for more than one period, and normally we don't cut it and sell it. So if that is the case, it is applicable. So Ind AS 16 is not applicable for biological assets. That means it's not applicable to normal plant. Let's say you're talking about a mango tree. Mango tree is not applicable, but it applies to bearer plant, but not applicable to the produce out of the bearer plant. I hope you understood. Next. So the measurement is normally at cost model. Subsequently, you can go for fair value model. Whenever there's a revaluation, you can do it at a frequency. Now it's almost a compulsory. I don't say it's optional now. Okay. Whenever there is a upward revaluation, credit revaluation surplus. Whenever there's a downward revaluation, debit P&L account. So other aspect is concerned fixed asset account or PP account. First time if you have done upward, subsequently the same category of asset, because revaluation is always for each class of asset, not for individual asset. First time if you have done upward, subsequently if you are doing downward, whatever treatment you have given earlier, it has to be reversed. So first year you credited revaluation surplus, now you debit revaluation surplus to the extent of balance available, because revaluation surplus would have come down because of depreciation being charged, and balance amount should go to the P&L account. Right? And any other profit or loss should be taken to the P&L account straight away. Next, frequency, it has to be done reasonably. Maybe revaluation can be done once in 3 to 5 years. That's what is suggested by Ind AS. One more special point of India 16. India 16 and AS 10, both are same, ditto. Component method of depreciation. I have an aircraft. The engine of the aircraft may last for 10 years, but the body may last only for 5 years. Separately, don't separate piecemeal, bolt nut kitak bede. Only purpose depreciation purpose. Engine should be depreciated for 10 years, body should be depreciated for 5 years. And SLM, WDV and units of production method. Note markole. There are 3 methods which are suggested by India 10. Right. What is the difference between depreciation, revaluation, and impairment? Depreciation is compulsory even in income tax. Revaluation is every year it is not compulsory. That's why it's optional. Once in 3 to 5 years, you can do it for each class of asset. And impairment is compulsory. So that we'll discuss a little later when I go to impairment standard. This same thing what we discussed. Fine. It elaborative notes because of the, yeah, I said there are 3 methods of depreciation: units, SLM, diminishing, and units of production. Fine. Employee benefit, India's 19. Anything paid to the employees comes under India's 19, except share-based payment, which is already covered under 102. So these payments, okay, so I given this share-based payment are 102, everything else is 119. They are basically covered under 4 RMRs. It can be short-term or it can be long-term. The long-term can be normally post-employment benefit or long-term employee benefits. Each item, the normal salary given is a short-term. There is no question of discounting coming to picture. You are paying every month here. Whereas post-employment benefit or long-term benefit, they are long-term. But there are 2 options. Either you can go by defined contribution plan, PPF. Once you pay 12%, forget it. That's it. You don't have to bother as an employer. Defined benefit plan is gratuity. Is a classic example where employee stays for more than 5 years to pay gratuity. But look at this example. Akshay is my employee. He stays for, let's say, 3 years. I don't have to pay gratuity. If he stays for 6 years, you have to pay gratuity from day 1. That is why there's an estimation required. Take the help of actuary. There's a 7-step approach which we have discussed down. Go through it. Termination benefits can be accounted as and when decided, like a short-term benefit. Same chart we are given in another approach. Who is Rama? The same language. Short-term normal accounting. Long-term either defined contribution scheme or defined benefit. Saptapadi 7-step approach. What has been discussed in the material. Right. Yeah, these are 7 steps. Please go through. Fine. Next, India's 20 deals with the government grants, and please remember the heading, the title of the standard, because that itself will give you 3-4 marks. It is almost equal to India's 12, almost same, because even there is an amendment recently. It is equal to AS 12 minus 1 special item. Capital approach is prohibited under India's 20. There is no capital approach, and certain additional disclosure points and forgivable limits, etc. coming into picture. AS 12 goes by capital reserve. Here it is only income approach. Government grant is recognized only when 2 cumulative conditions are satisfied. When there is a reasonable assurance that all the prescribed conditions are satisfied, and reasonable assurance that you will receive the same. So, subject to conditions, I said, types of grant. So, you look at the accounting. Revenue grant is taken to P&L. Capital grant, if it is related to depreciable asset, you can reduce from the asset value and accordingly claim depreciation. Athava, show entire asset at original cost. Deferred revenue grant can be shown on the liability side and amortized to the P&L account accordingly. If it is a non-monetary grant, let's say machinery of 100 lakh given free of cost, record at a nominal value, say 1 rupee, 100 rupees. 100 lakh worth of asset is given at 2 lakh, record at 2 lakh. No concept of promoter contribution. One extra point is in India's 12, forgivable loans. Government gives you a loan which is written off, taken to the P&L. Or they'll give you interest-free loan. That interest will be recognized as a government grant. Next, India's 21, almost similar to AS 11, that is the exchange. But one special point is, this is about international level we are coming to India. That's why there are 3 currencies. Functional currency, the primary economic environment where the entity operates. So let us say India, INR should be the functional currency. Foreign currency other than functional currency. But sometimes an Indian subsidiary of a foreign company may present its financial statement under US dollar. That's why their currency may be presentation currency. That's the third point. And theory question might be asked, how do you determine the functional currency? Please go through this, okay? Mainly the economic condition where you work, that decides the sale value, purchase value, receipt, etc. are to be considered. Fine. How do you translate initial recognition based on the date of rate, whereas balance sheet date, monetary items, which are convertible, monetary items are liquid assets and liquid liabilities, other than inventory and fixed assets mainly. Date of the reporting date. Non-monetary items, fixed assets, etc. Don't historical cost. I said that said go by the date of transaction and revalue. If there's a revaluation of the non-monetary asset, fixed asset, you can go by the date of valuation. So any exchange difference take into P&L. Net investment in a foreign entity, like a foreign operation, if you have, so almost everything is taken at a closing rate. Any exchange difference transferred to FCTR, which has to be kept in the other equity. Now FCTR is concerned as per Ind AS 21. Assuming 30% stake I had, if I sold entire 30%, transfer FCTR to P&L. If I sold 20%, proportionately I transfer to P&L, unlike AS 11, which says only when it's completely disposed of, transfer to P&L. Have energy to continue? You're able to absorb?
Yes, sir.
Okay, right. So, borrowing cost, extremely beautiful and simple standard. Any borrowing cost incidental to qualifying at a till the asset ready to use capitalized. Once it is capitalized, charged to revenue. What is borrowing cost? Interest and other cost. The definition is IFE. IFE is what? Interest, finance charges, and exchange differences incidental to borrowing. Qualifying asset is basically long-term asset, which may include inventory, which takes substantial period of time before coming into picture, before coming into existence. Normally, it covers fixed asset, but inventory, like ship construction industry, is applicable. Borrowing cost, which is specific, capitalized. If it is generic, go by weighted average cost of capital, proportionate. The special point as far as exchange difference is concerned. So, assuming you have taken a foreign currency loan, Aditi, note that point. Foreign currency loan, that exchange difference related to foreign currency loan, to the extent it gets adjusted to the Indian rate, it has to be capitalized or charged as a borrowing cost. Balance has to be charged to P&L. Just to give an example, assuming Indian exchange rate is Indian interest rate is 10%. You taken a loan from America at 4%. Now, if there's an exchange difference of 7%, so that 6%, there's a mathematical calculation, 6% has to be added to the cost of borrowing cost so that it will be almost equal to Indian rate. Balance 1% should be charged to P&L. This is one simple straightaway disclosure standard, related party, theoretically important. Related party, who is the related party? Related party transaction, related parties, if at any time during the year, they have two important points. Either they are able to control your activity or they are going to significantly influence. Holding subsidiary is a control. Girlfriend is a significant influence, where 20% and above if you have, so it will be associate company. It's called significant influence. If it is a control based, you must disclose compulsorily whether or not there is a transaction. Significant influence disclose only when there is a transaction in that year. Extremely important. Go through the examples of related party and examples of non-related party. Next, India is 33. Earning per share. Simple one again. On the face of the P&L, you must show for continuing, discontinued, and what you call total. Okay. And when it comes to the EPS, it can be basic EPS and diluted EPS. Patesh divided by weighted average number of shares is called basic EPS. Diluted is it gets diluted. Dilution can take place when ESOP, the employees will become a shareholder, conversion of debenture into equity share, conversion of preference shares into equity share. When you're doing diluted EPS, if you should keep on reducing, if it increases, it will become anti-dilutive. Ignore the anti-dilution. Next, IFR, interim financial reporting. A financial reporting for a period less than 1 year is called interim. It can be either complete or condensed. Condensed is what is suggested. Same balance sheet P&L account over for say 3 months, 4 months, what you do. IFR is not equal to IFR. Interim financial reporting is not equal to interim financial results as per SEBI requirement for listing agreement. Okay. And content, etc., can be presented either with a discrete view, each period as an independent period, or integral view where it is considered a total. Income tax is concerned, you should always go by a total approach unless it comes under two different previous year. Listen, April to March, you have to go by total tax divided by total income at 100, weighted average. Whereas if they're following January to March one period and April to December one period, then they come under two different previous year. You have to apply the applicable tax rate of the each year. I hope you understood that point.
Yes.
Right. Contents are same. Either you can go by condensed or complete, but normally condensed is what is suggested. The most important standard, Kara, impairment, and in Kannada, we say ಜಾಸ್ತಿ ಕಾರ ಹಚ್ಚಿದ್ರೆ ಬಾಡಿ ಪಾರ್ಟ್ ಒಂದೊಂದೇ ಹೋಗ್ಬಿಡುತ್ತೆ ಇಂಪೈರ್ಮೆಂಟ್ ಕಾರ. When CA is greater than RA, CA means carrying amount, book value. Carrying amount is original cost minus accumulated depreciation minus accumulated old impairment loss, if any. CARA. RA means recoverable amount. Fair value less cost to sale. Value in use, whichever is higher. This is nothing but net sale value. Value in use is present values of the future cash flows. So carrying amount is 100 lakh. Fair value is 110 lakh. Stop there. You don't have to continue. Only when the fair value is, let's say, 90 lakh, find out value in use. If value in use is 105 lakh, no impairment. So if fair value less cost to sell is 90, whereas value in use is 95. Very rarely we use the word whichever is higher. 90 or 95, whichever is higher is 95. 100 minus 95, 5 lakh is a loss. Additionally, in addition to the depletion, has to be debited to the P&L account. That's about the impairment. If you cannot do it for individual asset, you have to do it for group of asset. That is what is called cash generating unit. And whenever there's a CGU come into picture, first you need to write off to the goodwill. First allocate the impairment loss to the goodwill and then to the other assets in the ratio of carrying amount. And whatever impairment loss you're done, can you reverse it? Suppose tomorrow if there's a good market condition, can you reverse it? Normally, yes, sir, but goodwill cannot be reversed. Goodwill cannot. Goodwill is concerned very, very tough law. Fine. And also this impairment is leading to temporary difference, leading to Ind AS 12. The same stepwise approach I given. Reversal of impairment, I said. Goodwill you cannot. Other assets you can. And very important one special point here is the reversal of impairment. Let's say 100 lakh, you're done a 5 lakh rupees impairment loss for a plant. Now after 5 years, so can I reverse 5 lakh to the P&L account? No. You should find out, had it been no impairment, what would have been the WDV? Only that difference you have to find out. That in the regular class we have done the problem. Extremely important. Take care of it. India 37 deals with 3 RMRs, provisions, contingent liability, and contingent asset. What is a provision? The definition of provision is a liability of uncertain timing and amount or amount. It is a liability. What is a liability? OA, a present obligation which leads to outflow of cash, embodying economic benefit. And also additionally, it should be reliably estimated and you should be able to measure properly. Then you have to make a provision. So provision is always a liability of uncertain. Surabhi is my employee, 1 lakh salary, it is an expense. I sold TVs, I may have to do the repairs. That is a provision because amount is certain, how much is uncertain. Fine. So what is contingent liability? It is either a present obligation, but other OE conditions are not satisfied, or it is a possible obligation which may or may not. There is a contingent liability. Contingent liabilities are merely disclosed. Contingent assets are possible asset. Other conditions are same. Contingent assets are normally not disclosed unless it is substantial amount. Is substantially what you call virtually certain. I'm sorry, not substantial. Virtually certain. It is more than 95%. It is no more a contingency. It has to be bought inside the P&L. Sorry, financials. Fine. So the detailed discussion of the same. Go through it. Yeah, this table is important. Above 95%, it is no more a contingency. Bring it to the financial. 50 to 95%, it may be probable, whereas 5% to 95% is a contingent. Go to the table. Future operating loss. Normally, future operating loss are not considered. Only in the case of 115 related to construction contract, you may have to recognize the same. Okay, there's one more point. Appendix C. Overall, Appendix C is important. Appendix C is to 103 is common control transactions. Appendix C to Ind AS 37 is levies. If there's a government levy like a license fees you have to pay to the government, then it has to be provided mainly on a accrual basis over the period of the lease, etc. considered. Right. Intangible asset. The definition of asset is a resource controlled by the enterprise based on the past event out of which future economic benefits are expected. So the two important conditions, IEM or ICE, identifiable future economic benefit expected and measurable or IC, identifiable control over the resource and economic benefits are expected. Normally it is amortized over life. Correction over life. So Aditi, if life is unascertainable, so under look at me, under AS 26 is over 10 years. It's not under Ind AS 38. Ind AS 38 it has to be impairment. I repeat, correction here. If life is unascertainable, under AS 26 it is over 10 years. Under Ind AS 38 you should not go by 10 years. You should go by impairment test when the life is unascertainable. Understood? Research expenditure is always charged to P&L. Development, if 6 conditions of traffic are satisfied. technical feasibility, resource available, ability to use, financial issues, then intention to use, and cost can be measured reliably. Then all other points of PP are applicable mutatis mutandis, because tangible or intangible, only difference is they are identifiable. These assets are identifiable with no physical substance. Goodwill, etc., no physical substance. Fine. Next, last penultimate standard, Ind AS 40. So investment property, land, building, or both, 3 RMRs. I am a dealer in land, building, or both. That will become inventory. I am a chartered accountant purchasing building for my office, Ind AS 16, PPE. I am a chartered accountant, has surplus funds. I purchase a building, land, building, or both for earning rentals. That comes as investment property. It is a property held by the owner or lessee as a right of use asset. The amendment take care of it. And it is always valued at cost. I told you at the beginning, revaluation of the same is prohibited, but the fair value has to be disclosed as per Ind AS 40. Important. Whereas if you have got an asset which is used for as a PPE also as also rental, one building, ground floor is your office, first floor you give rent, you need to split it based on the information available, else it will be considered PPE always. Right. Next, Ind AS 41, the last Ind AS, agriculture. So the important definitions you have to go through. Biological assets, I said in 16, living plants and living plants and animals. Animals, obviously, living animal. Not. Biological assets are valued at fair value less than cost to sell. At the beginning, we have discussed about it. So it is a spoon feeding or spoonu feeding. Each standard is the most important point. Let's say Ind AS 101. So first time adoption, it has to be adjusted in other equity reserve surplus. Share-based payment, equity or cash settled, business combination, goodwill, total or partial, and separate point. Like this, I have given the gist of the gist. Please go through. Almost everything is beautifully given. Summary bolte hai iska. Okay, fine. Next, we have two important small topics. Integrated reporting. It is a report about how company thinks and performs. There are 6 capitals, IFM, HSN. Here I have given IFM, HSN, intellectual capital, financial capital, etc. And content of IR is SPBR, GUB. So what is the structure? What is the performance? Each item, these 8 items you have to buy out. It is a voluntary now. SEBI has given some voluntary requirement. It is not compulsory for any company to follow same. The last one is the CSR as per 135 of the Companies Act. Applicable if they satisfy any one of the 3 conditions. Corporate law you go through, they have to transfer 2% of the net profit, every net profit every year. And CSR expenditure cannot be allowed under income tax if it is explanation 2 to 37.1. However, it can be allowed under other provisions like 35 CCA, etc. And human resource accounting is not a new scheme. Old scheme people, in addition to that, value added statement is there. So account standards are ICA. Value added statement is I purchased the material at 100, sold at 500. The sale value minus bought out cost of material is 400. In that 400, how much did I pay to employees, wages? How much is the interest? How much is the depreciation, etc. Separately, you show that's what is called value added statement. It's something like PUC, you got 100 out of 100 in accounts. You came to CPT, hey, I know everything about accounts. Outstanding salary? No idea. So then you realize from CPT to final, how much validation happened. That is called validation. Human resource accounting also is there in the old scheme. Levi and Scott's model, where discount the future cash flows is one of the methods which is followed for what you call valuation. With this, we concluded the first leg of today's discussion. I hope you are reasonably enjoyed.
Yes, sir.
And imagine in 2 hours effectively, we covered the entire syllabus and reasonably everything I touched. Happy?
Yes, sir.
Yes, sir.
Yes,
When
sir.
you are able to recall?
Yes, sir.
Yes, sir.
When I can do, you should also do. When I can do,
We should
Must
also
do.
do.
okay. Now there are 2 options. I will give a short 5 minutes break and we'll continue that RTP, or I'll give 15 minutes break and we'll continue maybe even 15 minutes. 1 hour I may require. 45 minutes to 1 hour I require. Shall we take 15 minutes break?
Yes, sir.
Okay,
Yes,
right.
sir.
Let's make it like somewhere around 9:28. You come back. Okay, 9:28.
Sir.
Take care. On 10 to 12 minutes, you take a break.
So 9:14 times, sir.
9:40 now. Okay, 9:28. That's right. 9:28. You come back. Okay.
Okay, sir.
ಇಷ್ಟು ಮೆಟಿಕ್ಯುಲಸ್ ಒಬ್ಸರ್ವೇಷನ್ ಮಾಡಿದ್ರೆ ಸಾಕು ಲೈಫಲ್ಲಿ ಉದ್ಧಾರ ಆಗ್ತಾರೆ ಬಿಡಿ. ಓಕೆನಾ? ಅದೇನು ಟೆನ್ಷನ್ ಇಲ್ಲ. ಥ್ಯಾಂಕ್ ಯು. ಗುಡ್. ಯಾ. All of you are back.
Yes, sir.
Okay. We'll give
Yes, sir.
2 minutes. We'll give extra relaxation. Jairam. Yeah, ಬೇಕಾಯ್ತಲ್ಲಮ್ಮ
I'm back, sir.
ಯಾಕಾ
Yes, sir.
Okay. Welcome back. Continue, Aditi. Welcome back. Okay. So now this one poster, just for the benefit of all the viewers. No doubt, Corona is unfortunate, but I'm a B positive blood group. So I always look at the positive there. So we keep the fees so low so that everybody can afford. And mainly I'm targeting at my friends who are discontinued CA for whatever reason. There are a lot of issues for so many people. They have a golden opportunity to sit at home and study. And obviously, CAPS gives the best offline and online classes. That's what has been confirmed by you people. And it is a golden opportunity for all of you people. Okay, so especially those who have missed the train, okay, earlier. Okay, so convert your setback into comeback. Convert your setback into comeback and complete CA, because there is no degree which can match the CA degree. And obviously, I'm sure all of you are enjoying the sessions. Fine. So next is Tigamadana. Yeah, I can remove this. Yeah. Next one is today evening we have a session 6 to 9:30 it may be. Okay, so maybe again I may give 10 minutes break in between. Extremely important exam session. By mistake also, don't miss. So no doubt syllabus discussion individually I may do it on a new scheme, but old scheme also is relevant because majority of the general concepts are same. It's not just about the paper, everything is same. Next, November 19, suggested answer, you keep it ready with you. No doubt I'm screen sharing, but nevertheless, you can keep it ready with you. Next, a small joke. No doubt this class I will not be able to share a lot of jokes because of the time constraint. Mr. Ramesh went to a library and banged the book on the library and he said, see, what kind of nonsense book is this? I have taken this 2 days back. No story, nothing, only names and the numbers. What is this? So librarian slaps him and says, so you are the idiot who have taken our yellow page telephone directory. So yellow page telephone directory. Yeah.
Yes, sir.
Yeah. Next. I'm sorry. 1 second. Let us come to the next leg. You're able to see something on the board?
Yes, sir.
Yes, sir.
Okay. Moving? Is it moving?
Yes, sir.
Yes, sir.
Okay. Just give me 10 seconds. This size is okay?
Yes, sir.
Too much ಆಯ್ತಾ ಇಲ್ಲಲ್ವಾ
Correct ಇದೆ, sir.
ಕರೆಕ್ಟ್ ಆಗಿದೆಯಾ ಕಾಣಿಸ್ತಾ ಇದೆಯಾ
Yes, sir.
Without specs or with specs I don't know. Yeah. Okay. Okay, so let us venture into one more beautiful discussion. I said around 30 minutes to 40 minutes to do all these 20 questions. Maybe obviously I have not completely given the format, etc. But another 1 hour, let us understand this RTP. Maybe you can sit and practice all the sums. 2-3 hours you'll be able to do it. And trust me, definite 1 or 2 questions to be lifted from this, which is the phenomena which is followed by C Institute for several years. And unlike income tax, FRSFM should not take much time unless you're weak at maths. Income tax, yes. Okay, there are a lot of amendments, etc. And I have done one session with Bangalore branch of ICI, RTP analysis. I have taken around 2.5 hours. Please refer. It has come exceptionally well. Some of you attended also. Take care of it. Now, FR, I'll be just giving a glimpse of it. So keep your notes ready. Keep on writing special points, what I'm going to tell. Question number 1, question number 2. So I'll be doing question. It is starting with the question here and suggest the answer. Okay, so I'll also be showing the answers. Fine. Ready? All of you ready? 1%.
Yes, sir.
Yes, sir.
Okay. Now they are given a question. I'm just giving a glimpse, I said. First question. So there's an investment of 55%. So first point, note down all those. Otherwise, you can underline that or keep on writing. It will be easy for you. You can save time. And they are given the voting power related information. Voting power is proportionate to the capital contribution. So 2 within bracket 87, subsidiary company, the word is voting power now. So substance over form in Ind AS, even after having 55%, you may not be a holding company, you may not be a parent company, but they said voting powers are proportional to share capital, which is the normal phenomena. 1 share, 1 vote concept. So that means these people are going to, this company, Deepak Limited is going to become a parent company. Then they are given the financial statement of P&L. So P&L format is ROTE, ROTE, revenue from operation, other income, total revenue, expenses. Again, expenses only you have to show raw material consumption, stock in trade, etc. Then profit before ET, PBET, profit before exceptional item and tax. Remove exceptional item, remove tax, then tax expenses to be shown. Then if there's a discontinued operation, you should show, and EPS on the face. So now this is the question. Moment you see the question, you should know there are 1 or 2 mistakes here. What are 1 or 2 mistakes on the face of it? Quickly. I told you this.
Column.
Previous year column is not available unless they have mentioned somewhere in the first year of operation. Second, what else is missing on the face of it? EPS on the. This is a common question. They have asked almost all the 3 exams, recent examination. Next, balance sheet they are given. So if it is Ind AS company, you should not start with equity and liability. If it is AS company, yes, you have to start with this. This is the format for AS. So, but we'll see whether it's Ind AS or not. Then non-current asset, etc. They are given. This is not the format. Then deferred tax liability of 6,000 is due to the following temporary difference: depreciation amount as per income and accounting profit, which is as per AS language, tax based and carrying amount. What is the word used as per Ind AS? So they are given some other information. I'll not go too much detail into that. So I'll get into the answer and I'll show you. Yeah, I'll show you what are how you should answer this question. You're able to see the suggested answer, Surabhi?
Yes, sir.
Okay. So first read this paragraph quickly.
If Ind AS is applicable to any company, then Ind AS shall automatically be made applicable to all the subsidiaries, holding companies, associate companies, and joint ventures of that company, irrespective of individual qualification or set of standards on such companies.
So I said in the theory, what did I say in the theory class, Surabhi, first session? JASH. Once it is applicable to you, it is applicable to all the JASH, joint venture, associate, subsidiary, or holding company. Are you there?
Yes,
so
sir.
That means one of the companies here, there will be a clue. They would have followed Ind AS. That means you should also follow Ind AS. So first mistake, rectification of mistake. I hope you're understanding.
Yes, sir.
Yes, sir.
Right. So your P&L, so redrafted. Previous year column, again, they're not shown. You have to write previous year column has to be shown. You in the exam, at least you show, unless it is a first year operation. Sorry. Next. So look at this. At the end, also OCI also they have shown OCI, and also you should show the EPS here. They are not presented EPS. EPS presentation must mistake agade. Adhan correction ಮಾಡ್ಕೊಳ್ಳಿ. Then balance sheet is as per the new format, that is in division 2. Non-current asset today morning what we discussed, whatever is relevant for you. So non-current asset and current asset with all the disclosure. Equity share capital has to be shown separately. Other equity you have to give a schedule, and always have an extra column here for note number and show the information. So changes in equity share capital, opening, closing balance. So this is a new company, if I'm not wrong. That's why you should give a note saying that it being the first year of operation, previous year figures are not given. So previous year column also you should not put. Understanding?
Yes,
Yeah.
sir.
And
Yes,
other
sir.
equity, you have to show the information separately. Dividend declaration also comes here. Okay, fine. And disclosure regarding the part of financial statement. Dividend proposed is not an Ind AS 10 item now. It is not an adjusting item. It has to be just disclosed in the notes to account. Then they have shown individual item what have they done. So like this. So like as I was mentioning about the dividend, this is the information what they are given, and how you have arrived at the financial information they have given. Deferred tax computation they have done. We will be showing the question later. So carrying amount and tax base. Look at this. CA always write carrying amount. Then tax base 20,000. So it's a debit balance. That means deferred tax liability 20,000 to 30%. Easy.
Yes, sir.
Incorporation income expenditure in books they have written off everything. In P&L account 24,000 because 35D doesn't allow you immediately. The differential amount into 30%. So negative balance there's a DTA. In the positive balance there's a DTL. I hope you understood. This is about the first question. Redrafting the question with the what you call the mistake. Fine. Alt tab. We are used to alt tab. I'm doing alt tab again and again. Fine. The next question, make a note of it. Question number 2 is about what? Ind AS 28. So Ind AS 28 is you recognize the investment at equity method. Equity method. Equity method is equal to partner's capital shown in the balance sheet of the firm. Is equal to initial investment, what you have paid, 47,50,000 plus 35%. They said use the word 35%. 35% of any profit, revaluation profit, revenue profit, any profit, minus dividend. Minus dividend. Are you there?
Yes, sir.
Yeah. Now, Ind AS 28 allows you to either follow cost method. You can you can follow the you can follow equity method by understand the formula what I give. Oh, I'm used to this alt tab like what you do now in the office. So look at this. The way they have shown the calculation investment as per equity method. They have used the word equity method. There's one more question actually. It's something related to this. Will come a little later. So what is the initial investment you have made? Initial investment, cost of investment, 47,50,000. Are you there?
Yes, sir.
Yeah. So they have given a split off of the same. Then what is the profit made? Any profit. There is a revaluation loss. Loss means minus karo. Then every profit you keep on adding and the dividend received is the only item, you should minus it. This is the closing balance as per equity method. So those who don't know, I repeat this. In the regular class, we have done good number of time. In initial capital, in the partner's capital, on the credit side, initial capital, share in profit, salary received, interest received, anything on the credit side, add everything, minus drawing. Instead of minus drawing, use the word minus dividend received. So somewhere you write make a note of it. Draw a line. Heading investment 0 to 20%, normal investment 20% to 50%, associate, normally we call it as associate, equity method 50% to 100% is subsidiary. All of you agree? Yeah. So below 20 to 50%, 20 to 50%, you write Ind AS 28 equity method. 50 to 100%, that is more than 50%, 100%, Ind AS 110. Understood? I hope you understood.
Yes, sir.
Yes, sir.
Okay, left hand, no usage, only right hand. Okay. Next question, Odama, quick again.
Entity A is awarded a government grant of 60,000 receivable over 3 years. That is 40,000 in year 1 and 10,000 in each of years 2 and 3.
So 40 plus 10
Contingent
plus
on
10.
creating.
So write down your notes, sir. So government grant 40,000 plus 10,000 plus 10,000. Understanding?
10,000.
Yeah.
Yes, sir.
Next.
Contingent on creating 10 new jobs and maintaining them for 3 years. The employees are recruited at a total cost of 30,000 and the wage bill for the first year is 1 lakh, rising by 10,000 in each of the subsequent years.
So write down.
Calculate the grant income.
Write down. So I'll give some gist. Okay. So government grant 60,000, that is 40,000 plus 10,000 plus 10,000. First point. Second point, wage bill, first year 1 lakh, second year 1,10,000, third year 1,20,000. 1,20,000. Further, in the first year, additional cost of recruitment, like HR consultancy fees you would have paid, no? That is 30,000 rupees. Artha aita?
Yes, sir.
Additional cost of 30,000. Making it 1,30,000. Make it 1,30,000. So what you should do, that government grant, you have a portion in the salary ratio. That is a portion in salary ratio. So see the answer there. Can you see the table, all of you?
Yes, sir.
1,30,000, 1,10,000, 1,20,000. I'll mistake andre. First year is 30,000. 30,000 is nothing but salary recruitment charges, recruitment HR charges. So what is the total? 60,000. The 60,000 has to be a portion in this ratio. 130 is to 110 is to 120. So first year, second year, third year. This is the P&L. The column missing here. P&L. So that what is deferred? Look at this. First year you received 40,000. Understand carefully. Out of that 18,000. Out of that. That amount, I think columns are not correct. Make a note of the columns. Okay, Barcode just for your understanding. Here is column A, or column A. Labor cost is B. Grant income is C. Then so the amount is not fixed, printed. Next column number D is what? Credited to P&L. That amount 60,000 to 130 by 360 comes to 21,667. So out of 40,000 received in the first year, 21,667 you recognize. What is the amount which has to be deferred? That 18,333. Young month 18,333.
Yes.
40,000
Yes,
minus
sir.
40,000
21,667. Artha aita?
Yes, sir.
Second year again,
Yes, sir.
same way you should do. But second year total amount is 50,000. Out of that 21,667, this amount comes to 18,333. Third year balance amount will be taken and nothing will be deferred. I hope you understood. Easy alva?
Yes, sir.
Okay, right. The next question is question number 4. It is about India's 12 and 103. Okay, this is one more. Write down. All of it, write down. So you have to do individually, but I will be doing on a total basis. Okay, write down. Tax base continues even in transferring company. Next, fair values will become carrying amount. Carrying amount. Next, all of you listen. So here, this book value is not relevant for you. This carrying amount is really carrying amount. Is the total. I have done it yesterday night. You just do it. Write down. First left side carrying amount 1330 assets minus 260 liabilities. See, there are two ways of doing this session. Either I will allow you to read the question and then solve everything, but it will take a lot of time. But I thought I'll just give a gist, then you can sit and solve. Is it okay with the second approach?
Yes, sir. It's fine.
Yes. Yes, sir.
If you have to solve everything exam, I only have to write. For all 100 students, if I have to write, it's difficult, no? I have to take Vishwarupam of Sri Krishna Paramatma. 1,330 minus 260, it becomes 1070. 1070 the carrying amount. Right side, tax base. So you have to add up this. Tax base 1080. Just trust me and write 1080. And minus 160. It comes to 920. Therefore, CA minus TB. Always start with carrying amount. CA minus carrying amount. 1070 minus 920 is equal to 150. Debit balance or credit balance?
Debit balance.
Debit balance, taxable. Excellent, Jairam. Taxable TD. TTD. Tirupati Tirumala Devasthanam. TTD. Therefore, DTL, 150 lakh into 40%. They are given the rate 40%. 40%. Because you are doing for S limited jurisdiction. 40%. Impond. That is also impond. Jurisdiction may with the tax rate. 40%. S limited jurisdiction. 40%. See, even though you're absorbing S limited, ultimately S limited will pay the tax in its jurisdiction. It comes to make a circle for 40%. Important, that is 60 lakh. Deferred tax liability. Artha aita? Therefore, revised carrying amount ಎಷ್ಟು ಬಂತು ನಿಮಗೆ 1070 ಬಂದಿದೆ ಮೇಲೆ ಕರೆಕ್ಟಾ?
Yes, sir.
1070 minus 60 ಎಷ್ಟು? 10
10.
that is equal to 10 lakh 10,000. That is rupees in thousands ಅಂತಿದೆ. 1010 ಅಂದ್ರೆ 10 lakh 10,000. ಅರ್ಥ ಆಯ್ತಾ?
Yes, sir.
Next, therefore goodwill is equal to beauty consideration paid 100% ಇದೆ ಇಲ್ಲಿ 100%, no confusion. So consideration 15 lakh minus 1010 ಎಷ್ಟು? 490, 4,90,000. 4,90,000 is the answer what they have done. See, you in the examination, please do individual basis. Kelskota idira? Same thing, whatever I have done a total basis, they have done it individual basis. So deferred tax liability calculation. How much you got deferred tax liability? For 60. Tax rate is important. I hope you are concentrating.
Yes, sir.
So goodwill is 490. One more sentence you write. No amortization of goodwill, comma, no deferred tax for goodwill. I think you understood.
Yes, sir.
Next, question number 5. You're enjoying what I'm doing?
Yes, sir.
Okay. Now this question is about whether the provision has to be made or not. COVID-19, okay, the companies can make a contribution anta the relaxation measure given by the government. Government of India has given a notification. So on 31st March 2020, that notification has not come. It has come afterwards. So if you make a provision for this contribution, whether it should be recognized as per India's 37 is the question. So India's 37 says provision is a liability. It should be existing on 31st March. So 31st March, this is not a decision you have taken. You have taken it afterwards. Hence, it is not a provision. Barkodi. Just a gist. Okay. As per India's 37, such provision for contribution payable can be considered as provision. Consider provision if it satisfies the criteria of present obligation as on reporting date, balance sheet date, reporting date. However, please go through the question later on, you'll understand. However, it doesn't satisfy the same, hence no provision. No provision. Further, it is a non-adjusting item as per India's heading.
37.
Adjusting and non-adjusting. India's 10.
Yes, sir.
India's 10. Full stop. Next line. If it is allowed for previous year 1920 itself, this expenditure, COVID-19, if it is allowed for 1920 itself, but in accounts you are making a provision in 2021. Allowed for previous year 1920 itself, but in accounts considered in 2021, it is a temporary difference leading to DTL. It is a temporary difference leading to DTL. Understood, my dear friends? Why DTL, you tell me? DTL and save now, pay later. Save now, pay later. So because next year expenditure you are allowing this year only. In income tax, you are saving, you have to pay later. That's why it's called DTL. Whereas DTA, pay now, save
Pay
later.
now, save later.
Save later.
Excellent. All of you understanding?
Yes, sir.
Yes,
Please,
sir.
one more. Question number 6, I allowed it. Barkodi. Question number 6. Quickly read the question. Quick, beautiful question.
A contractor enters into a contract with a customer to build an asset for 1 lakh with a performance bonus of 50,000 that will be paid based on the timing of completion.
Statute.
The amount of the
No,
performance.
you read, I'll give you comment. Number 1, you write. Consideration 1 lakh plus bonus 50,000. Next, Odama.
The amount of the performance bonus decreases by 10% per week for every week beyond the agreed upon completion date.
Okay, so they said this is what happens in the construction contract. They delay substantially. That's why they say performance bonus. Be careful with the word used is contract amount alla. 50,000 matra kamme agadu. 50,000 will come down by 10% every week. Then they somewhere they're given next para.
The contractor estimates that there is a 60% probability that the contract will be completed by the agreed upon completion date, a 30% probability that it will be completed 1 week late, and a 10% probability that it will be completed 2 weeks late.
Okay, right. Therefore, what is the transaction price? Copper. Ali transaction price ಹೆಂಗ್ ಮಾಡ್ತೀರಾ ಬರ್ಕೊಡಿ. So write down transaction price. I'm giving you only gist. Ali first you write copper ಬಗ್ಗೆ ಬರಬೇಕು. What is revenue? What is the transaction price? Explain, and then write copper. Next, transaction price is 3 RMRs. 60% of entire 1,50,000. Why you tell me? 60% probability that it will be completed on time. That means you'll get 1,50,000 ka 60%. Understanding?
Yes, sir.
Sir.
Plus 30% of starter bracket. It is an expired question. 30% of starter bracket. Please understand the performance bonus kamme agodu. Contract value kamme agala. So 30% of starter bracket, 1 lakh plus 45,000. Why 45,000 you tell me?
10% reduce ಆಗಿದೆ.
10% reduction. 50,000 ka 90%. Close the bracket. Plus balance 10%. 10% of starter bracket. 1 lakh plus 40,000. Why you tell me? 20% minus ಆಗತ್ತೆ. ಫಾಸ್ಟ್ ಆಗ್ತಾ ಇದೆಯಾ?
ಅರ್ಥ ಆಗಿಲ್ಲ ಸರ್.
10% probability ಇಲ್ಲಿದೆಯಲ್ಲ 10% probability that will be completed by 2 weeks. Each week ಎಷ್ಟು percentage reduction ಜಯರಾಮ್?
10%.
10% for 2 weeks ಎಷ್ಟಾಯ್ತು? 10%.
20%.
20%. So 50,000 20% minus ಮಾಡಬೇಕು. ಅರ್ಥ ಆಯ್ತಾ?
Yes, sir.
Yes, sir.
I repeat, this little tension for me because I want to give it in a smart approach, but you have to absorb also smartly. First 1,50,000 into 60%. Is artha aayta elrigo?
Yes, sir.
Second point is 1 week delay. They said it is given. No, she read no 1 week delay. How much is the probability? 30%. 1 week delay 10% kamme agutte. 50,000 minus 10% 45,000. 45,000 plus 1 lakh into 30%. Next 2 week delay andre 10% 20% kamme agutte. 50,000 into 20% minus ಮಾಡಿದಾಗ it will become 40,000. So 1 lakh plus 40,000 into 10%. So total comes to 147,500. Those are not understood. Look at the board now. So fixed price 60% of 150, 30% of 145, then 10% of so and so. I think you understood.
Yes, sir.
So dash, right? So next, right? Therefore, transaction price based on probability weighted estimate. Okay, next question. India is 34. Question number 7 ಬರ್ಕೊಡಿ. IFR is what? Interim financial reporting. 2 RMRs. Normally, same question ನಿಮಗೆ ಸ್ಟಡಿ ಮೆಟೀರಿಯಲ್ ಇದೆ. ಅಲ್ಲಿ 25,000 ಫಿಗರ್ ಇರಬೇಕು. ಇಲ್ಲಿ 10,000 ಫಿಗರ್ ಚೇಂಜ್ ಆಗಿದೆ ಅಷ್ಟೇ. 2 RMRs. Normally, consider weighted average tax rate of the entire year. And apply for each period, or each IFR. And normally IFR we suggest discrete view. This is only way where taxation should be on a total basis. Right side. However, if it falls under 2 different previous years, income tax will use the word previous year, apply the tax rate of each such previous year. In the given case, accounting year is January to December, important, but tax year is April to March. Am I too fast?
No, sir.
No,
Accounting
sir.
year is Jan to December, whereas tax year is April to March. Next. Question nodi. Entity's profit is 10,000 for each quarter. So next line. Profit 10,000 per quarter. And tax rate for 18-19 is 25%. And tax rate for 19-20 is 30%. Therefore, 2 RMRs. For the first quarter of accounting year, apply in Jendu Mama
25%.
25%. Right side. For the next 3 quarters, apply
30%.
30%.
30%, which in the bracket average rate also comes to same. See, next 3 quarters again, average rate also comes to same. That is total income 30,000. Next quarter matra total income 30,000. Total tax 9,000. 9,000 by 30,000 ಎಷ್ಟು ಬರುತ್ತೋ?
30%.
ಹೌದಾ? ಶಾಕಿಂಗ್ ಆ? Yeah, 30%. So look at the answer that one. This is important. Normally you would have done average rate, but there are 2 different financial year, extremely crucial. First quarter they have done 25%. Next 3 quarters 30%. I hope you understood.
Yes, sir.
Yes, sir.
So,
Yes,
next,
sir.
enjoying? Is it not so easy questions? So after attending
Yes,
the regular FR class, revision class, almost everything you know. Only 1 or 2 extra point which is given, you have to take care. Next question is about RPD. I don't want to waste much time. If X owns 95% of entity A and he is also a director, he is also the beneficiary of a trust that owns 100% of entity B, of which he is a director. First question, whether A and B are related? 100% yes, sir. Because A is also a beneficiary of trust B, etc. Answer is yes, sir. Next, they are given, if X resigned as a director of entity but retained 95%, it is still a related party because actually you are going to influence the same. Next question is, yes, resigned as a director of entities A and B, transferred 95%. So 25%. The answer may be no unless you maintain significant influence. Barkodi. India is 24. India is 28, 24. Related party. 2 RMRs, control based, right side, significant influence, connect left with right, apply substance over form, below the right side, that significant influence, star mark akbari, significant influence on what? Punch word. Significant influence in operating and financial policies. Punch word. Or you can also use the word substantial interest on that. ಅದರ ಬಗ್ಗೆ ಸ್ಟೋರಿ ಇದೆ, ಗೋ ಥ್ರೂ ಮಾಡಿ. ಪ್ಯೂರ್ ಥಿಯರಿ. ಐ ಹೋಪ್ ಯು ಕ್ಯಾನ್ ಡೂ ಇಟ್. ಅರ್ಥ ಆಯ್ತಾ?
Yes, sir.
Yeah. Next, India is 41. This is one more beautiful question again. Mathematics. Quickly over, quick and fast. 30th June.
Entity A purchased cattle at an auction on 30th June 2019. Purchase price at 30th June 2019, 1 lakh. Cost of transporting the cattle back to the entity's farm, 1,000.
So it will
Sales
become
price
1
of the
lakh
cattle
minus
at 31st
1
March
lakh.
2020 is 1 lakh.
Yeah, okay, continue.
The company would have to incur similar transportation costs if it were to sell the cattle at an auction, in addition to an auctioneer's fee of 2%.
2%.
The auctioneer charges 2% of sale price. The auctioneer charges 2% of the selling price from both the buyer as well as the seller.
Yeah. So how do you account for the same under India is 41? And also, how do you measure the fair value? Beautiful question, interconnection. So, Barkodi. See, I was telling in the regular class, India's 113 is not an independent standard as such. So many standards will say recognize at fair value. Recognize fair. What is fair value? The measurement is given in Ind AS 113. I hope you remember that. So Ind AS 41 says
Yes,
fair
sir.
value is cost to sell. What is fair value? 113. Barcoding. As per Ind AS 41, biological assets, cattle, dana, hasu, cow. As in Ind AS 41, biological asset, cattle is recognized at a fair value less cost to sell. Next, Ind AS 113 gives guidelines for fair value measurement. Gives guidelines for fair value measurement. So on 30th June, 30th June, initial recognition, 2 RMRs, cost 1 lakh plus 1,000 transportation cost plus 2%. 1 lakh plus 1,000 plus 2% of the cost, that 1 lakh, 2,000, that auctioneer fees, 1 lakh 3,000. What a cash outflow?
03.
ಕೇಳ್ಕೊತಾ ಇದ್ದೀರಾ? 1 lakh 3,000. ಅರ್ಥ ಆಯ್ತಾ
Yes.
ನಿಮಗೆ? 1 lakh plus 1,000 rupees is the transportation cost, 2% of the auction fees, 1 lakh 3,000. Right side, fair value less cost to sell. Fair value less cost to sell. ಉಲ್ಟಾ ಮಾಡ್ಬೇಕು ಅದನ್ನೇ. Because when you purchase, you have to pay 1,000 rupees, pay 2,000 rupees. The cost will be 1 lakh 3,000. But if you have to sell to bar today, fair value less cost to sell. 1 lakh you have to incur, less 1,000 rupees transportation cost, minus 2,000 rupees auction fee. Because they said for both purchase and sale, they charge 2%. I hope you have seen that sentence. Are you there?
Yes, sir.
Yes, sir.
Go through in detail later. I am giving only trailer. Fair value 1 lakh minus 1,000 minus 2,000 is equal to 97,000. So, but the initial recognition at 97,000, whichever is less. Basically, it should be fair value less cost to sell actually. Whichever less better. Sorry, don't write that. I'm sorry. Connect and write. Initial recognition at a fair value less cost to sell 97,000. Therefore, loss on initial recognition 6,000 charged to P&L. Understood?
Yes, sir.
Yeah. Next, 31st March 2020 is a different date after 9 months. 31st March 2020. Here also, you always value fair value less cost to sell. Right? Fair value 1,10,000 minus 1,000 minus 2% of 1,10,000. Fair value minus ಮಾಡಬೇಕು. It comes to 106,800. So you have to measure at that value. Next line. Therefore, effectively, the indirect profit over 9 months is equal to 97,000 minus 106,800. Because initially your like opening stock is 97,000, closing stock is 106,800. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ?
Yes,
Yes,
sir.
sir.
9,200. Ninth opening stock is 97,000. Kirtana closing stock is 106,800.
106,800.
That means 9,200 is the difference. I hope you understood.
Yes, sir. Yes, sir.
Okay, right. 9,800.
800.
9,800.
9,800 is the income indirectly. So like opening stock and closing stock. Beautiful question. Go through it. Repetitive question ಬರುತ್ತೆ ಇದೇ ತರ. Next is about India 36. 36 ಏನು? ಖಾರ. ಏನಪ್ಪಾ? ಖಾರ. Okay, next. Very important. Very India 36. Extremely important question again. This is 1 million is equal to 10 lakh. First point. ಅದು ಮಿಸ್ಟೇಕ್ ಆಗುತ್ತೆ ನಮಗೆ. 1 million is equal to 10 lakh. First point. Second point. Stronger currency to weaker currency multiply. ಇದು ಬ್ಲಂಡರ್ ಮಾಡ್ತೀರಾ ಮಾಡಬೇಡಿ, ಬ್ಲಂಡರ್ ಮಾಡ್ತೀರಾ ಮಾಡಬೇಡಿ. Stronger currency to weaker currency multiply. Say $1 is equal to 70. $2 lakh is equal to 2 lakh into rupees 70. ಕೇಳಿಸ್ಕೊತಾ ಇದ್ದೀರಾ?
Sir.
Yes, sir.
Rupees 140 lakh. So stronger currency in the weaker currency. Unfortunately, Indian currency is weaker as of now compared to dollar. Wait for some time. We'll become the stronger country at the earliest 2025. APJ Abdul Kalam's vision 2020 to 25 now. 2030 everybody says, but I want it to be 2020 because all of you are going to become a chartered accountant at the earliest. Atmanirbhar Bharat, contribution to the country. Thank you. Yeah, adu trailer alle heliddu. So ಏನಪ್ಪ ಅದು 140 lakh. Next, weaker currency to stronger currency. Divide, multiply Allah, divide. అక్కడ చూడు జయరామ్, పౌండ్ ఇది ನೋಡಿ, ಇದು సింబల్ కడ పౌండ్ 1 is equal to $1.60. ಇಲ್ಲಿ ಡಿವೈಡ್ ಮಾಡಬೇಕು.
Yes, sir.
Next, in the given question, information is in US dollar, which is weaker currency. ಇಲ್ಲಿ ಮಿಸ್ಟೇಕ್ ಮಾಡಿದ್ರೆ ఎక్కువ ತಗೋತೆ, ಏನು ಮಾಡಕ್ಕಾಗಲ್ಲ. Weaker currency compared to pound. Pound is LBM ಅಲ್ವ ಅದಕ್ಕೆ. ಅರ್ಥ ಆಯ್ತಾ?
Yes, sir.
Yeah. So now what they said is they purchased one property at 1.8 million and exchange rate is sold. So American UK entity Sterling as a property located in US. So at the balance sheet date, its value came down to 1.62 million and exchange rate has gone up to 1.8. So you have to find out what is the impairment. Brilliant question. Barkodi. Cost of buying, initial measurement. Cost of buying or initial measurement as per Ind AS 16. Read with the Ind AS 21. Historical cost we say. Both go hand in hand. Here harmonious construction. ಅರ್ಥ ಆಗ್ತಾ ಇದೆ ದೇವರಿಗೆ?
Yes, sir.
Is equal to 1.8 million divided by 1.6 divided by 1.6. It comes to 1.125. Trust me and write. I have done it and kept it ready. That's why I see bookal ಮಾಡಿ ಇಟ್ಕೊಂಡಿದ್ದೀನಿ, not to waste your time. 1.125. ಅದೇನು 1.125 pounds ಆಯ್ತು ಅದು. Pounds. Right side. This is the carrying amount. Okay, so we carrying amount. There is no depreciation information bit hacking. Right side carrying amount. That's 1 by 1. Left side is carrying amount. Right side recoverable amount. Recoverable amount is fair value less cost to sell minus or net selling price, whichever is higher. If the fair value is not available, then you have to go by value in use. Sorry, value in use or value in use, whichever is higher. So recoverable amount is to 1.62 divided by what is the rate on that day? 1.8. ಗೊತ್ತಾಗ್ತೈತೆ ದೇವರಿಗೆ? 1.8
Yes, sir.
1.8 is 0.9 million pound. Therefore, CA minus RA. First is CA 1.125 minus RA. How much? 1.125 minus 0.9 is equal to 0.225 million. ಅಥವಾ into 10. 1 million is equal to 10 alva, or is equal to 2.25 pound. 2,25,000. I'm sorry, 2,25,000. ಕೇಳಿಸ್ಕೊತಾ ಇದ್ದೀರಾ ಎಲ್ಲರೂ? Pounds.
Yes, sir.
Yes, sir.
2,25,000 pounds. 2,25,000 pounds. 0.225 ಅಥವಾ into multiply by 10 because you are doing millions. 2,25,000 is the impairment loss. Beautiful impairment loss. ಅರ್ಥ ಆಯ್ತಾ? So this is how you have to interconnect the standard. Carrying amount is 9 lakh and carrying amount is how much? 11.25 ಅಥವಾ 1.25 million. ಅದು ಕನ್ಫ್ಯೂಷನ್ ಆಗ್ತಾ ಇದೆಯಾ?
Yes, sir. Clear, sir.
You got 1.125 ಅಲ್ವಾ? 1.125.
Yes, sir.
10 ಮಾಡಿದ್ರೆ 0.25 ಬರುತ್ತೆ. That's how they got 11.25. ಗೊತ್ತಾಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
Yes, sir.
Next, recoverable amount is 9. Recoverable amount. They are used the word carrying amount. It's not the right word. You know the recoverable amount. Go by my approach. Stepwise ಮಾಡಿ. So 2.25 is the impairment loss. How did it happen? Now you see the question. Two reasons. One is, but maths mistake ate ಮಾಡ್ಬಿಡಿರಿ. 1.8 has come down to 1.62. So property value coming down. Next one is currency weaker ಆಗಿದ್ದು. 1.6 has become 1.8. So divide ಮಾಡುವಾಗ if the number increases, it is a weak. It is a loss. Multiply ಮಾಡುವಾಗ if the number increases, it is a benefit. ಅರ್ಥ ಆಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
Yes, sir.
So 2,25,000 made up of 2 RMRs. Left side, change in property value. Change in property value. 1.8 million minus 1.62 million is equal to 0.18 million dollars divided by 1.8 at the end rate, closing rate, 1.8. If the PP is measured at a fair value, you also have to take the value as on fair value date. Correct alva? Ind AS 21. You are understanding at least 90%?
Yes, sir.
10% because you are not seeing the question carefully. So 0.18 divided by 1.8 is equal to 0.1. 0.1 into 10
Lakh.
is equal to 1 lakh. 1 lakh,
Pounds.
Pounds.
lakh pounds. Right side, Ind AS 21 ಪ್ರಕಾರ ಕರೆನ್ಸಿ ಚೇಂಜ್. ಇಲ್ಲಿ ಬ್ಲಂಡರ್ ಪಾಸಿಟಿವ್ ಏನ್ ಮಾಡ್ತೀರಾ ಗೊತ್ತಾ ನೀವು?
Balancing figure.
1.8 minus 1.62 divided by 1.8 ಮಾಡಕ್ ಹೋಗ್ಬೇಡಿ. Because mathematical knowledge says when there's a division you have to do individually. Difference division ಮಾಡಂಗಿಲ್ಲ. I repeat this. There's a blunder positive 1.8 minus 1.62 divided by 1.8 minus 1.62. Exchange rate ಮಾಡಕ್ ಹೋಗ್ಬೇಡಿ. Individually you have to do it. ಬರೀ 1.8 million divided by 1.8. That's a coincidence. It is 1.8 million divided by exchange rate 1.8 minus 1.8 million closing rate. Value at what? 1.6 at the beginning. 1.6. ಗೊತ್ತಾಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
1.8 million divided by 1.8 minus 1.8 million divided by 1.6. Exchange rate difference ಆಗಿದೆ ಅಷ್ಟೇ. See,
Yes, sir.
one second. I think you people are not
Balancing figure ಬರಿಬಹುದು sir.
ಆಗಲ್ಲ. ಅದು ಬರೀಬಹುದು. That's fine. That's next. That's the last approach. So ಬರ್ಕೊಳ್ಳಿ 1.8 divided by 1.8 minus 1.8 minus divided by 1.6 is equal to 1 minus 1.125 is equal to 1,25,000. So totally 2,25,000 top ಅಲ್ಲಿ ಇದೆ. ಗೊತ್ತಾಯ್ತಾ ದೇವರಿಗೆ? 2,25,000. 1 lakh is because of property value change and 1,25,000 is because of the exchange component.
Exchange.
So now I was maybe some of you have confusion. I repeat, sir, 1.8 value has come down to 1.62 million. I'll confusion is gotta. This is also 1.8. This is also 1.8. All confusion. Chitrana. This is US dollar 1.8 million property value. 1.62 million comes on the left side. So that has to be valued at the closing rate. What is the closing rate? 1.8. Next one is the exchange rate has gone up. 1.6 has become 1.8. Closing value is 1.8. Keep it as it is. The difference of 0.2. Or as he rightly said, 225 minus 1 lakh is equal to 1,25,000. Everybody understood?
Yes,
Yes,
sir.
sir.
Next question. India is 109. This is basically India is 109 and India is 21. 21 is extremely important. So this is again normal calculation. Something similar to the previous one. Ali entry pass ಮಾಡಬೇಕು. Okay, ಅದಕ್ಕೆ I'll just show you the answer. ಬರೀ question number 11. Calculation etc. by India is 21. India is 21. 21 and recognize 2 RMRs. Left side, interest income and exchange gain. exchange gain, say realized in P&L. This is important. India is 109. Our exchange gain, what you take it in the P&L is called FVTPL, fair value 3 through PL. Arthak idea?
Yes, sir.
Right side, unrealized FVT OCI, fair value through OCI. If it is realized one, it goes to P&L account. If it is unrealized, it goes to OCI. All of us sleeping?
No,
No,
sir.
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 Right. In the given case, initial cost of the bond 40,000. So you have to be extremely careful. $1,000 bond, initial rate is 40,000. Next two change agide. One bond value 10010 has become 1,060. That means like a previous question, value change. Arthak idea.
Yes, sir.
Sir.
And 40 rupees exchange rate has become what?
45.
So
Right.
exchange rate. So ditto like a previous one. I hope you're understanding.
Yes, sir.
Okay, right. Fair value at the end. 1,060 into 45 is 47,700. So 7,700 increase the bond value. Further, interest received, or the calculation is they are given the percentage, whatever the dollar into percentage, 4.7%, it comes to 2,655. Total 7,700 plus 2,655, 10,355. Recognized as under 2 RMRs. Left side P&L. Under P&L 2 RMRs. Interest income accrued at 10%. They are given in the question. Don't worry about this. 10%, 4,200. Second RMR, exchange gain realized. Realized 5,000 plus 300. There is a calculation here. 5,300. So complete right side through OCI. Here you can say balance figure or differential amount. That calculation part, please do. Like the previous question, only you have to do it. Martira.
Yes.
Yes, sir.
Yes, sir.
And this entry note mark important. Asset account debit to bank account debit to interest income to whatever. So this entry is important. I'll jaga note mark entry. Okay. So otherwise calculation instead just like the previous question. Fine. So next one, question number 12. This is a beauty. Okay, work amazing. India's 2. Question might come in the exam. What is the normal production? They were 1 lakh. How much is the normal production? 1 lakh.
1 lakh.
Inventory valuation. 2 RMR. Left side cost. Right side NRV. NRV not given. NRV formula is selling price minus estimated cost of completion if it is the work in progress minus estimated selling expenses. Left side cost 1 by 1. Material 200. Labor 100. Variable over 100. Fixed factory overhead. Important. Fixed factory overhead. You write 100. Sadhik 100 at the break. What is the total? 500. Yes,
sir.
Yes, sir.
Right side not given. So whichever is less. So 500 per unit. 500 per unit. Next, a fixed factor overhead star mark akbaradi. Here, budgeted production or the normal production 1 lakh. Theory ಹೇಳಿದ ಅದೇ question ಇದು. Class regular class ಅಲ್ಲೂ ಮಾಡಿದೀವಿ ಇದನ್ನ ನಾವು. ನೆನಪಿದೆಯಾ?
Yes, sir.
Yeah.
Yes, sir.
Regular production 1 lakh. Actual production 50,000 being lesser. Hence, for fixed factory overhead, consider
Budgeted.
budgeted units or normal units. Next point, cost here means cost up to works cost in cost sheet. Costing. Teachers costing also know. Cost up to works cost in cost sheet, meaning O&A, S&D overhead are excluded. ಇಲ್ಲಿ ಕೊಟ್ಟವ್ರು ನೋಡಿ ಸೆಲ್ಲಿಂಗ್ ಓವರ್ಹೆಡ್ ಅಂತ ಇದೆ ಕ್ವಶನ್ ಅಲ್ಲಿ ಕನ್ಫ್ಯೂಸ್ ಮಾಡಕ್ಕೆ ಸುಮ್ಮನೆ ಕನ್ಫ್ಯೂಸ್ ಮಾಡಕ್ಕೆ ಕೊಟ್ಟಿದೆ ಎಕ್ಸ್ಕ್ಲೂಡ್ ಮಾಡಬೇಕು ಅರ್ಥ ಆಯ್ತಾ
Yes, sir.
Such an easy question for 5 marks here. Look at this 500 per unit and ಇದು ನೋಟ್ ಕೊಡಬೇಕು. This is an amendment which has happened 2 years back. Fixed factory overhead ಬಗ್ಗೆ so class ಅಲ್ಲಿ 2 times ಹೇಳಿದೀನಿ ಇವತ್ತು 2 times ಹೇಳಿದೀನಿ take care of it with note. Next question I think India's 10 ಇಲ್ಲಿ ಬರ್ಕೊಳ್ಳಿ India's 10. Look at me. Hi. This is again the class same point I discussed. Fire broke on 10th May, 10th April. So it is not accrued on 31st March. Adjusting item or non-adjusting item? Sorry, Becca.
Non-adjusting.
Non-adjusting.
ಕೆಲವರು adjusting ಹೇಳಿದ್ರು ಸರ್ ನಾನ್ ಅದು ನೆಟ್ವರ್ಕ್ ಇಶ್ಯೂ ಅಲ್ಲಿ ತಿಂದು ಹೋಗ್ಬಿಡ್ತಾರೆ ಇಲ್ಲೋ ಏನ್ ಸ್ಮಾರ್ಟ್ ಇದಾರೆ ಬಟ್ ಐ ಆಮ್ ಯುವರ್ ಟೀಚರ್ ಯಾರ್ ಕಮ್ ಆನ್ ಮೇಡಮ್ ಯಾ ಫೈರ್ ಆಕರ್ಡ್ ಆನ್ 10th May, after reporting date. No condition existing. ಅದರ ನಂತರ ಇನ್ಶೂರೆನ್ಸ್ ಏನೋ ಹೇಳ್ತಾರೆ ಅದು ಬರ್ಕೊಳ್ಳಿ. No conditions existing on 31st March. 31st March, 2 RMRs. Left side non-adjusting. You should not do the changes in 31st March. Non-adjusting item. Right side. However, if going concern is affected, auditing allu barutte. ಏನು ಎಸ್ ಎ ನಂಬರ್
70.
ಹಾ
570.
560 ಏನು
Subsequent.
event.
Correction. 560 subsequent. 570 is what going concern. So if going concern is affected, then financials have to be drafted accordingly with the disclosure. I hope you're enjoying.
Yes, sir.
Story ಕೊಟ್ಟವರೆ ನೋಡ್ಕೊಳ್ಳಿ. Okay. Next question ಬರ್ಕೊಳ್ಳಿ. Question number ಯಾವುದು 14 ಅಲ್ಲ? Yeah. This is ಈಗ don't waste your time in wasting that IPL match etc. So IPL ಎಲ್ಲ ಸುಮ್ಮನೆ ಟೈಮ್ ಪಾಸ್ ವೇಸ್ಟ್ ಆಫ್ ಟೈಮ್ ನೋಡ್ತಾ ಇದ್ರೆ IPL if you watch at least maybe your exam is May 21 also doesn't matter. Trust me ಮತ್ತೆ pills ತಗೋಬೇಕಾಗತ್ತೆ ಮಾರ್ಕ್ಸ್ ನೋಡ್ಕೊಂಡು ಅದಕ್ಕೋಸ್ಕರ don't watch IPL, don't waste your time. Okay, it is related to that only. It is a recruited player. ABC Limited Private each franchise would have recruited a player. And as per the terms of agreement, player is prohibited from playing for any other entity for the coming years, etc. So the question is that player retention, is it a intangible asset? Is the question. Barkoli. Theory gottidre answer bandbidutte ashte. As per India's 38, an intangible asset can be recognized if it satisfies para number, etc. You may not have to remember. Don't worry. If it satisfies ICE, identifiable, control over the resource, future economic benefits expected to flow. I hope you are able to recall.
Yes.
Expected to flow. Further, it should be measurable reliably with a fair estimate. Ide punch word barbek, same word, fair estimate. In the given case, company has control over, because he cannot pay anywhere else. He has a control over the player. Hence, such right a player alla. ಈಗ RCB ನಲ್ಲಿ ವಿರಾಟ್ ಕೊಹ್ಲಿ is not the asset. The right over Virat Kohli is an asset. Right over the player can be identified as intangible asset. One important point. Red ink bari those red ink. However, is ella case bari itar intangible asset bandaga. However, be careful while assessing facts and circumstance. Each case is different. The Indian concept big bash legally same irlikilla. They are different concepts. This is one question number 15. It is about exchange of assets. Barkodi. When there is an exchange of asset, India 16, small a. If there is a commercial substance, recognize the asset acquired at the fair value of asset commercial substance, recognize the asset acquired at its fair value, semicolon. If it is not available, you are not able to get the fair value, then consider fair value of asset given up. Next line, small b. If the transaction lacks commercial substance, then recognize the asset at the carrying amount of the asset given up. That figures you go through it, easy question. Carrying amount of asset given up, that is 1 lakh. 1 lakh less further amount received 5,000 is equal to 95,000 in the books of X. So whenever there is exchange of asset and if the commercial substance, etc., you can prove it, then you go by the fair value of the asset acquired. If not available, asset given up. If it is not, use the word carrying amount. Underline the word carrying amount, less any extra amount you receive. I am not very comfortable with the answer given here because in my opinion, fair values are reasonably available and commercial substance also is available. But I have to go by the sales street approach. That's why I followed it. If given an option to me, I would have gone by fair value information because almost everything is given. But since C Institute says actually commercial substance lacks, we have gone by the carrying amount. Next, India is 27. In India is 27 Barkode. What is India is 27 for? Separate financial statements. Karada? Hello? Audible?
Yes. Yes, sir.
Barkode. Ilanda, I am talking to whom? Yeah. So India is 27. Investment in subsidiaries, associates, etc. Investment in subsidiaries, associates, etc. 2 RMRs. Either cost approach, or measurement as per India's 109, say FVTPL, fair value through PL. Connect and write. Consistently followed for each category of assets. Crucial word, consistently followed for each category of assets. So next line, say all subsidiaries at cost. All subsidiaries at cost and all investments as per India's 109. Permissible. Reading Calvary. Whereas associate A1 at cost, associate A2 at 109, associate A1 at cost and associate A2 at 109, not permissible. This is the theory question they have asked. They are asking whether you can value at cost and what you call subsidiaries at cost, investments at 109. Okay. Whereas one associated cost, one associated 109, not okay. Artha aita?
Yes, sir.
Badkoli, sir. Badkoli, yeah. Next one is again one more beautiful question on 16, Ind AS 16, ಯಾವ್ದು Ind AS 116, ಯಾವ್ದು Ind AS 116 lease
Lease.
agreement. ಬರ್ಕೊಳ್ಳಿ. Yeah. In the given case, X entered into lease agreement with entity Y lesser. Annual lease rent 70,000 for 9 years. Just trust me and write all these figures I'm reading from the book. Annual lease rent 70,000 over 9 years. Additionally, 1 lakh rupees for facilities like DG set, then parking space, 1 lakh rupees for DG set. Aggregate consideration 1,70,000. So, however, as per standalone pricing, it should have been 1,20,000 and 80,000 respectively. Therefore, 1,70,000 substance or form splitting. Even your multiple price arrangement ಬಗ್ಗೆ starting class I used to say. Initial class of Ind AS ಅಲ್ಲಿ ನೆನಪಿದ್ರೆ regular class ಅಲ್ಲಿ ನೆನಪಿದೆ ಯಾರಿಗಾದ್ರೂ?
Yes, sir.
Therefore, 1,70,000 has to be apportioned substance over form ಅಂತೀವಿ ಇದಕ್ಕೆ. So even though you are receiving 1,70,000, you should recognize not 70,000 and 1 lakh. You should apportion in the ratio of 1,20,000 is to 80,000. And lessee should recognize present value of minimum lease payment present value of minimum lease payment 587,316 as ROUA and lease liability. And a balance amount of 68,000 should be recognized as non-lease component of the facility, or towards facility, as an expense for the lessee. It is an expense in the P&L as and when incurred. But refer tables in 22 and 23. Now, total amount is 1,70,000. Yes, Papa? All of you look at the board. 1,70,000. How much is the lease component? How much is the non-lease component? That's the question. So they say building rent, you are paying building towards, you are paying 1,02,000. Sorry, not that. You are paying building rent, you are paying how much? 70,000. And for the facility, how much you are paying? 1 lakh. Now they say this is by form you are doing it. Simply you are done. But if you have gone for a standalone transaction, you will have paid 1,20,000 rupees lease rent and 80,000 rupees only for the facility. So what you should do, this 1,70,000, you have to apportion the ratio of 120:80. So 1,70,000 anna, you apportion the ratio 120:80. Artha aita?
Yes, sir.
Yes, sir.
Now, this 1,02,000, it comes to 1,02,000, 68,000. And 1,02,000 you will be paying for how many years? I said 9 years. 1,02,000 is the lease payment over 9 years. Converted to today's value, 587,316. So, this will be considered as a lease component. And the balance 68,000 what you are paying, service charges, okay, should be recognized as a non-lease component separately. I hope you understood.
Yes, sir.
sir.
Important. ಸ್ವಲ್ಪ confusing. Enjoy. Okay. This is one simple, beautiful question. You have to identify operating, investing, and financing. Work code India 7. India 7. Number 1. PPE, intangible asset, and long-term investment, investing activity. Anything related to that. Anything related to that. Next, share capital, security premium, borrowings. Yenado?
Financing.
Financing. Any other item is operating. Operating is a balance figure. This I see. I'm so happy for this question. ನಾನು income tax ಬಗ್ಗೆ ಕೇಳಿದ್ದೆ ನಿಮಗೆ. Income tax APR under which head ಅಂತ ಕೇಳಿದೆ. Surabhi says operating. You are right. Jairam says investing. You are right. Dhanush says it is financing. You are right. Bari income tax 3 RMRs. Capital gain tax on building sale. Building is a fixed asset. How activity?
Investing.
ನಮ್ಮ ಕ್ಯಾಪ್ಸ್ ಮೆಟಲ್ ಡಿಟ್ಟೋ ಈ ಚಾರ್ಟ್ ಇದೆ. Investing activity. Second remark. DDT. DDT is dividend distribution tax on dividend. Dividend is on share capital. How activity?
Financing.
Financing.
Right side. All of the things operating. Operating. Connect and write. Show separately under each head. ಬೇರೆ ಕಡೆ ಮರ್ಜ್ ಮಾಡಂಗಿಲ್ಲ ಅದು. Show separately under each head. Red ink ಅಲ್ಲಿ ಕೇಳ್ಕೊತಾ ಇದ್ದೀರಾ ಇನ್ಕ್ಲೂಡಿಂಗ್ ಇನ್ಕಮ್ ಟ್ಯಾಕ್ಸ್ ರಿಫಂಡ್. ಅಷ್ಟೇ ಕ್ವಶನ್ ಆಯ್పోయింది 5 ಮಾರ್ಕ್. ಏನು ಸೇಲ್ ಕನ್ಸಿಡರೇಷನ್ ಆಫ್ ಅನ್ ಅಸೆಟ್ ಅಂಡ್ ನೆಕ್ಸ್ಟ್ ಒನ್ ಲೈನ್ ಯು write the actual cash flows. CFS is a cash flow statement. Write the actual cash flows. Say sale value of the asset and not profit or loss on sale. I think you enjoyed.
Yes, sir.
So sale consideration is a fixed asset, investing activity. Capital gain investing, business profit operating, tax on business profit operating, dividend payment financing, dividend distribution tax financing. Then income tax refund is related to business and it is operating activity. Then you have to add all investing together, all operating together, all financing. OIF, P&L, assets and total money. ಆಯ್ತು ಅರ್ಥ ಆಯ್ತಾ ನಿಮ್ಗೆ ಎಲ್ರಿಗೂ?
Yes, sir.
Yes, sir.
ಈಸಿ ಅಲ್ವಾ? ಈಸಿ ಅಲ್ವಾ? ಅಕೌಂಟ್ಸ್ ಈಸಿ ತಾನೆ? Yes, ಹೇಳ್ರು. First.
Yes, sir.
Yes, sir.
Yeah, very good. Niranjan. Now, this question is about 103. This is a beautiful question. Barkodi. India is 103. Normally, acquirer is equal to an entity issuing equity interest. But in case of reverse mergers, legal acquirer may be
Accounting subsidiary.
excellent. Accounting subsidiary. Classically, we have done it. We have done problems also on that. Then here we are again, what do you call, discussing. Legal acquirer is equal to what? Accounting subsidiary. In the given case, total share capital 150, 2 RMRs, held by Veera, V for Vellore. 100 shares are held by Veera, Dhira, Shura ಅಂತ ಹೇಳ್ತಿರಲ್ವಾ ಆ ತರ Veera. 100 shares, left side 100. That is 66.67%. ಯಾಕೆ? Out of 150, 100 is 2/3. Correct ಅಲ್ವಾ?
Yes, sir.
66.67%. Right side, Zira. So, Veera Limited ಅಂತ ಹೊಸ ಕಾನ್ಸೆಪ್ಟ್ ಬಂದಿದೆ. The ditto question regularly we did, one of the classes we did. So, in our classes, where amalgamation ಆಗುತ್ತೆ, but B Limited takes over the control of A Limited. All of you sleeping?
No, sir.
No,
No,
sir.
sir.
No, sir.
So, ಇಲ್ಲಿ Veera Limited is at the top ಅಲ್ಲಿ Veera Limited issuing 150 shares. 150 shares ಪ್ರಕಾರ issued by what? Veera Limited, new company, held by Veera Limited shareholders ಎಷ್ಟು? 100, 50. That means 1/3 ಅಥವಾ 33.33. So who is the accounting acquirer? So below the left side, Veera ಕೆಳಗೆ ಬರ್ರಿ. Veera is the accounting acquirer. Have you understood, my dear friends?
Yes.
Yes, sir.
Yeah. So information just compile ಮಾಡಬೇಕು ಅಷ್ಟೇ. So that is the answer given there. Just glance it. Para number 103 reference ಮಾಡಬೇಕು. See same thing what I finally conclude. But you sit and practice all the sums. Today, tomorrow itself we close it. Next, the last question. India is 40. ಬರ್ಕೊಡಿ. India is 40. Investment property. Say for LBB for capital appreciation, rent, etc. Renting kali compulsorily valued at ಹೇಳಿ.
Cost.
Very good. Valued at cost. Compulsory valued at cost. But show the fair value below such item. Show the fair value below such item. Understanding?
Yes, sir.
Fine. Further, one second. Further, investment property is shown. ಎಲ್ಲಿ ಬರುತ್ತೆ ಬ್ಯಾಲೆನ್ಸ್ ಶೀಟ್ ಅಲ್ಲಿ? Balance sheet investment property is shown as third item. Correct? Under non-current assets. ಬರ್ತೋಯ್ತು ಫಾರ್ಮ್ಯಾಟ್ ಅಷ್ಟು ಬೇಗ?
No, sir.
Right side. Such investment property is subject to what? Subject to depreciation, comma, full stop. Depreciation, rental income, etc. shall be shown in P&L. ಅಷ್ಟೇ ಇರೋದು ಈ ಕ್ವಶನ್ ಅಲ್ಲಿ. ಸೊ ವ್ಯಾಲ್ಯೂಯೇಷನ್ ಬಗ್ಗೆ ಎಲ್ಲ ಇದಿದೆ ನೋಡಿ. ಯು ಆರ್ ಏಬಲ್ ಟು ಸಿ ದ ಆನ್ಸರ್? ಮೂವ್ ಆಗ್ತಾ ಇದೆಯಾ ಸ್ಕ್ರೀನ್?
Yes, sir.
ಸೊ ಡಿಪ್ರಿಸಿಯೇಷನ್ ಇರುತ್ತೆ. ಡಿಪ್ರಿಸಿಯೇಷನ್ ಇರುತ್ತೆ. It is only cost model, no revaluation model. There is starting story bari only at the cost, blah blah blah. But depreciation is possible. Okay, fine. So how do you measure? They are given opening balance, addition. Normally in India is 116. India 16 ಮಾಡ್ತಿರಲ್ಲ ಗೊತ್ತಲ್ಲ ಎಲ್ರಿಗೂ? Okay. Then the rental income should be taken in the P&L. Earning rental income, there is a direct expense that also minus ಮಾಡಿ. Depreciation also has to be taken to P&L account. So they have done the net impact of this investment property. What is net impact also? They have shown the presentation. So that's it on the presentation ceremony. All of you are enjoyed?
Yes,
sir.
sir. Thank you, sir.
Yes, sir.
Yes, sir.
Thank you. So I have taken on 10-15 minutes extra than what I expected. Nevertheless, okay. So what we did today is the entire FR revision, the new scheme, entire revision, new old scheme also reasonably connected, and entire RTP, okay, which is around 20 questions. Now, when I looked into the question paper, sir, what about amalgamation, then consolidation questions nahi hai? CA final question paper analysis in the evening. The CA in the evening we'll discuss about it. We'll not go into the FR discussion, but question paper analysis we'll discuss there. So when I can do it in 3 to 4 hours entire FR, so today evening I will be giving you a timetable management. With that, how well you can do it, you can only decide. All of you enjoyed?
Yes,
Yes,
sir.
sir.
Yes,
So
sir.
just normally in the
Yes, sir.
offline classes in 1 hour, 1.5 hours I used to do the FR revision. So today, because we have got online facility, etc., I've taken 3 to 4 hours, including RTP. RTP for the first time I'm doing for accounts, because it's almost same like what we discussed. But still, I thought let us do it. You don't require 2 to 3 hours. So your job now is those are writing November 20, and if you're obviously leave, finish everything what we discussed today only, so that you can spend little extra time for other subjects wherever you're a little uncomfort. So FR, what a mark you're going to get?
100, sir.
120.
400, aim at 100, aim at the moon. At least if you become a star also, I'm happy. That's the target of our life. So thank you one and all. God bless you. Thanks to
Thank
each.
you, sir.
Thank you,
Thank you,
sir.
sir. Bye, sir.
Thank you, sir.